Okay, so we want to finish up some of these risks. This is not a catch-all of other risks, because some of these I think are actually really very, very important. It's just they're not as quantifiable as the others. And because they're not as quantifiable, we don't have a lot of math problems to do. But you don't want to ignore these, because these are the ones that can kill you. So we'll start with legal risk. Legal risk, you have a contract and it's not enforced the way you're intended. Now, remember, the purpose of a contract is to shift risk. And a lot of times the purpose of a contract is to decide what happens when something horrible happens. So 95% of the time, the contract, you don't even notice it, but it's that 5%. You're like, wait, what did we sign up to? Who gets what? And you don't want to find that out at the time of a crisis. So there's been famous cases out there where people thought they had a contract, they thought they knew how it was going to be interpreted, and you find it out at the end. And if it goes to courts, it's going to cost you a lot of money. I talked about the swap contract. You know, they're just very, very hard language to understand. They're not written in user-friendly language. So a lot of times they're talking about some fairly simple things, but they use convoluted language. And if in finance you're doing something that's your firm hasn't done, doesn't have background on, there's probably not a lawyer anywhere in your firm that knows how to do it. And I was shocked. I was asking my 9 o'clock class what they did in business law, and I was really surprised that they don't really have business law, right? It seemed like y'all didn't have the business law I had. Boy, we studied the UCC code, how to structure a contract, valid components. You know, there's a lot of stuff in there. I thought, oh, I got business law. I had 6 hours. I'm done. I don't have to worry about that again. And then I go to UTSA and I'm writing contracts. And I didn't think I'd be writing contracts. I'm not a lawyer. I go to the lawyer and say, hey, I need this contract. And he says, well, write what you need and I'll put the boilerplate in. And I would write what I need. He put the boilerplate in and he would never read anything I wrote. So I was like, but this is really kind of scary. I don't know what I'm doing. So I was hoping, you know, let's hire someone from outside. Let's get some expertise on this, because it's tough. But your firm is not going to hire a lawyer to do swap contracts if your firm's never done a swap contract before. You know, and if you got brokers you got to hire and all this kind of stuff. So, you know, you may have to ask for outside help or whatever, or you might be on your own doing it. So, you know, what legal background do you have? I know a couple of students. I've talked about going to law school, right? I mean, law school needs finance people who understand the finance side, because these contracts get incredibly complex. Y'all are talking about doing structured debt.
Yeah.
Structured debt, that's a very complicated contract of who does what happens if things blow up.
Yeah, those are not, they're not user friendly.
No, and the lawyers writing it, I think get paid by the hour. So their goal is to write the most convoluted, lengthy contract they can. You know, they could write these contracts much more simply if they wanted to, but they don't want to. How do you measure it? How many pages is it? How complex is the language? You know, with me reading a swap contract, I would read a paragraph over and over, and I was like, I don't know what this means. And the lawyers couldn't help me either. It's just really, really frustrating. How do you mitigate it? One thing I learned is write what you want. So write exactly what you want. So I thought, what am I worried about? So on the swap, my number one thing on the swap, because I was dealing with investment bankers, Morgan Stanley, Goldman Sachs, JP Morgan, fortunately not Lehman. We never did anything with Lehman, but we did have a contract with Morgan Stanley. Remember, Morgan Stanley could have gone under in 2008. So that was the contract I was worried about. So my whole question to the lawyers was, how fast can I get my money out? I want to be able to make a phone call, and in 10 minutes, I've got my 300 million bucks or whatever it is, just like that. Does this language say that? Because I read that paragraph, I don't see that. And I want them to say yes. And I want them to have some confidence when they say yes, that they can do that. So, you know, that's the kind of thing. So go to the extreme, because that's when the contract's the most important. When the world is blowing up, because most of the time you don't care. You have a contract, you never reference it, everything just works normally. Go to the extreme, because that's the whole reason why you have a contract. I do that with when I used to live in apartments, that's what I did. I'd read the contract and say, what's the worst thing that could happen here? It's like, I'm not signing up for that. I'm not, the contract was trying to shift risk to me that I didn't want. It's like, no, I don't want that risk. That's an awful lot of risk for me to pick up. Why are you doing that? So read it carefully. Don't trust lawyers. Lawyers will say yes a lot of times just because they don't have time to mess with it. So make sure, so go to the extreme. So you're telling me that if this and this happens, you're 100% sure I'm going to get this back. Do you know that for sure? Have you dealt with this before? You know, they're going to kind of be irritated with you, but it's like, hey, my career is on the line here. You know, I don't want this thing to blow up on me. They're trained to know what they're talking about, but they may not. So you've got to approach them in a way. Okay, hey, I want to do something we haven't done before. It's pretty complex. I realize you're pretty busy, so we might need some, you know, set it up so that you give them the right to say, yeah, I don't know what you're talking about, without it making them sound like they're stupid. You know, set it up that you really don't think they know what this is about, because it's pretty complex. Give them that out and they'll say, yeah, let me think about it, or let me talk to someone. Usually they'll call someone at a firm that has some experience with that, or they'll know someone. They're pretty good networked people. And you know, it's finances has gotten far too complex, these contracts, especially the over the counter kind of stuff. So test it, read it, double check it. The next one's disclosure risk. So let's talk about a disclosure. All right, so FAS 157. Do y'all know FAS 157? How many of y'all know FAS 157? Is that 0%? So what is FAS 157? It's the one FASB every finance major should know, and maybe even actuaries. Anybody have any guesses? 157. If I use the word level, does that help you? What accounting has to do with levels? Huh? It's fair value accounting, yes. Mark their assets to market. Do you think finance people care about that? Huge, right? This is a huge one. You're running a portfolio, you're running a mutual fund. You're recommending assets that are going to go on the GAAP balance sheet. Like I was doing swaps and options. Fair value accounting, extremely important. And there's 3 levels, level 1, 2, and 3. They were real inventive, those accountants. And that the levels depend on how easy it is to get a market value for something. So if you're owning publicly traded stocks, very easy. That you just go out and get the value. You're trading bonds, a little more difficult. Bonds don't trade every day. Bonds do have model values. I don't know if you've heard of that. Model values, that's the value it should be if markets were normal. So you can trust those prices. 2008, markets weren't normal. So model values weren't very helpful. I still remember days where, you know, you call your broker, get a price, and they say 92. You say, okay, 92. So it's 8% loss. That's fine. And then the portfolio manager says, you know, 92, that's a pretty good price. Why don't we sell? And so they call the broker. Yeah, we want to actually sell at 92. And they say, oh, you want to sell? Well, then it's 73. That's the way 2008 was. 92 is the price it should be trading on based on models. But if you want to actually sell it, there are no buyers out there. We can get it for 73. But what do you do when you're putting the assets onto your, you know, the NAV at the end of the day for your mutual fund? And a lot of times you have a bond doesn't trade, and then one trade happens. Now you have a market value, but you know it's a horrible market value. You actually have to mark all those down. And it's not just that one security. You mark that one security down, and what about all the other securities that are similar to it that have a similar model? You have to mark all of them down. Now you have new information. So some assets are tough, and then some assets are practically impossible because there's just no market value out there. So Investopedia does a pretty decent job here. Level 1 assets are those valued accordingly, readily observable market prices. They're marked to market, treasury bills, marketable securities, foreign currencies, gold. Level 2 assets and liabilities, and they're mentioned liabilities here, so this is pretty key as well. Do you mark your liabilities to market? This was a big deal with life insurance companies because their assets are fairly easy to mark to market, but their liabilities there's a lot of assumptions behind it. And what was killing life insurance companies in 2008 is their assets were falling 15, 20%. And they felt like their liabilities were falling that much as well, but they couldn't mark the liabilities down. So they were just seeing these massive losses of their net worth. These assets and liabilities do not have regular market pricing, but can be given a fair value based on what? A model of some kind. Quoted prices, models, interest rates, default risk, yield curves, interest rate swaps. There are ways to get the values off of this because you have some sense of what markets are doing, or you can see a spread on another market that's very similar and you can apply it here. Maybe it's a similar rating or something like that. They're not absolutely reliable, especially if you want to do an actual sell, but mutual funds have to mark every single asset to market every single day by 5 p.m. They've got to put something down. And so they use a lot of modeled prices because a lot of these assets are not traded every day. So you do your best. One thing we discovered at UTSA, we were using, options. Was it in the mutual fund? I can't remember. I think we're using options one of mutual funds. And they were using last price, the very last price of the day. Well, that might have been at 1 o'clock. And in 2008, markets were moving 10% in the last 5 minutes. The last price was really old information. And so I'd look at my mutual fund, I would call them up and I'd say, there's no way that NAV is correct. There's just no way. So we finally had to stop using last price and going to last bid and ask and doing midpoint between those two. Because last price, they're used to using last price because that's something that was actually traded as observable, but with an option, that can be really old information. So we had to change how we got that information. There's some mutual funds, we discovered this with our 401k plan. It was pretty amazing. They were discovering that when the US market was down, the next day, the international markets were going to be down. That's pretty obvious, right? S&P's down 3%. You can expect international markets to be down. So we had people in our 401k plans, based on what the S&P was doing, they were trading between our cash account and our foreign stocks. And in a year when the market was flat, I tried it. I didn't do it with money. I did it kind of just modeling. When the market was flat, they were up 80-something%. That's pretty good. And we had to shut them down because they weren't making money. They were essentially stealing from the other 401k providers. And so what most of those international funds, probably all of them now, have done is they'll actually reprice their Japanese stocks, even though the Japanese market's been closed for several hours, they'll reprice it off of some kind of model off of the US market, basing some kind of statistics. That way the NAV was actually adjusted. But stuff like that, you have to, last traded price may not be the most reliable there. And then level 3, these are assets based on models and inputs, but they may be inputs only the people own the assets really know, because they're just very thinly traded assets. They're not actively traded. Their values are estimated. Could be things like private equity, real estate, very subjective. They say mortgage-backed securities. I don't think mortgage-backed securities are quite that subjective. They are modeled. Usually mortgage-backed securities are priced off of simulation, but private equity definitely. Over-the-counter derivatives. Foreign stocks, I just mentioned that, foreign stocks, those are pretty reliable, but if the market closes at a certain time, you may have to use some kind of algorithm. Distressed debt, obviously. Mark to management, I'm not exactly sure what they mean by that, but there's certainly some subjectivity to that. If you're on the investment side, you're going to have to learn these rules pretty well. We had a committee that had to meet anytime something moved more than X%. We had to meet and make a decision. My first 2 years over there, we never met, and then in 2008, we were seeing each other almost daily. It was just a crazy year. What do you do with these assets once? And the biggest issue was someone trades an asset that hasn't been traded in months in the middle of a horrible market. You now have new information. What are you going to do? And you have to make some decision. And it's tough. So that's FAS, which one? 157. They really should. I know they have the accounting for finance majors now, right? I think they should spend like a week just on FAS 157 because it's probably more important to you than closing entries or pooling of interest, those other things. This is probably what you need to know. Another one you need to know is FAS 133. Y'all know FAS 133? Accounting for what? You know, you can probably read it up there. For derivatives. That's pretty important, right? How does FAS accounting say that account for derivatives? And a big part of FASB is why we're going to study this when we do one of our case studies. You're buying a derivative to hedge something. And they're going to ask it as a price hedge, it is a cash hedge, and the rules are going to be different. So you might say, well, you know, I'm hedging this thing, so it's down 20% when my hedge is up 20%. So those two offset each other. But sometimes FASB accounting will say, no, you can't mark both of them to market. And then you got this problem. You got this hedge that looks really good economically, but it doesn't show up on the financials. It doesn't go through GAAP accounting. And so we're going to, in this case, we're going to see with this case, US accounting actually marked the market really well, but European accounting didn't. And so one side, it looked really good. The other side, it looked like a loss. And now people are saying, wow, you're just cooking the books or whatever. So it gets really, really tricky. FAS 133 is not an easy FASB to read. It is quite complex, very, very difficult, especially when you're dealing with over-the-counter derivatives, where there's a little bit more difficult. But the key is when can you use hedge accounting? So maybe apply it if the hedge documentation and gains and losses and the value derivatives, gains and losses and value underlying. So you have to set it up correctly. So we were hedging our pension plan and no one at USA had ever done swaps before. And so everybody was like getting really, really nervous. And then USA hired this person from Pete Marwick and he'd done this several times. And I was like, whew, this is great. I went to his office. We had a 30-minute meeting. Everything was fine. Before that, they're like, you know, I was like, here comes Ron. Everybody was hiding. It's like, here comes, you know, he's going to have us do all this work to figure all this out. My boss walked over with 2 books that thick on FAS 133 and put it on my desk. He says, you want to do derivatives? Read this. I was like, thanks, boss. That's really helpful. So, you know, when you talk about disclosure, you are doing something that is going to have an impact on the financials. You might think you're hedging and nothing to worry about, but you might be absolutely shocked at the end of the day how the accounting actually comes out. And then one last one is FAS 52. You can guess on that one is foreign currency. I don't think there's a FASB more complicated than this one. Just absolutely insane. We'll talk about currency risk here in a little bit. But transactions, translations, y'all remember, y'all do that in your accounting classes? Y'all get the translation? Just absolutely ridiculous accounting. I don't know if they intentionally made it complex or it's just that it's just complicated. Currencies are complicated. It creates a lot of gains and losses that are, I think, are kind of surprising. And when we get the currency, you'll see that definitely. So those are the 3 I think, you know, you should be pretty concerned about. I think 157 is probably the most important one for you to know, but the others you should have some familiarity with. Sometimes it doesn't matter so much because like FAS 133, if you're in a mutual fund, everything's marked to market, so you're probably okay. It's when you're in GAAP accounting into a company like a bank or an insurance company, that's where you can get some surprises. So what is disclosure risk? Disclosure risk is you can't manage the risk because the reporting is just too complex. You can't figure it out. It's just too much. How do you measure it? Well, how many rules, how many pages are the rules? How complex is the language? Some of this is regulatory disclosure. I think I got an article down here on Dodd-Frank. Y'all heard of Dodd-Frank, right? One of the most bizarrely named. You have Dodd, who was, you know, possibly getting kickbacks from the banks that he was regulating. that could have caused the entire 2008 crisis, and now he's writing a bill to regulate that. You got Frank, you say, hey, don't worry about Freddie Mac and Fannie Mae, they're fine. A couple of days before they went under, they're the ones writing our, let's figure this risk stuff out, and they obviously didn't know what they're doing. Not that anybody in Congress can figure this out, but just how complex Dodd-Frank was, it's incredible. So how do you mitigate it? For me, on the accounting side and legal side, it's hit those people early. If you have legal issues, you have accounting issues, you have tax issues, go to them at the very start of the process, realize that they're busy. Everything I did was overtime to them. They didn't know my project was going to show up. So I'm essentially begging them for their time. Now, fortunately, USA, we'll talk about tax risks. USA has, or at least at that time had, and probably still has, just an incredible tax department, very research oriented, just incredible people. So, they were set up to do that. Research is part of their job. The accounting side, I kind of got lucky in them hiring that one guy at just the right time. That really helped. You're going to see when we talk about currency risk, I did not have that help. And so then I was very much at their mercy. But catch them early and let them know, hey, this is complicated. I need your help. Don't go to legal guys and gals and say, can we do this? Because what are they going to say? You come to the lawyer and say, hey, can we do this? They're going to say no. Why? Because they just saved themselves several hours of work. So you come to them and say, hey, this is really important. It's really critical. We have this issue. I need your help and how we're going to get this done. You got to somehow get them on your team. They're busy people, right? Everybody's busy. You walk into a lawyer, so I don't know if it's how honest they are. I think they bring in stacks of paper just from home and put it on their desk and make it look like they got a lot of work. So I'm not so sure they're really as busy as they say they are, but they are busy people. Everybody's stressed. Everybody's working overtime. You just got to realize you want to do something that may make a lot of sense, but it's complex. It hits all these different departments. Get to them as early as possible as you can. Hire people and spend a lot of time reading and thinking through the scenarios. You just have to have people working for you. You may have to get lobbyists on your side. There's several times at USA. I know lobbyists have a bad, reputation, don't they, to most people? But boy, I learned there was time Congress was talking about stuff that really was quite ridiculous. It wasn't that we just didn't like it because it cost money or whatever. It was really going to cause major damage. And the lobbyists did a good job. We hired people who could get in there and talk to them. So, sometimes that's what you have to do. There are times your greatest ideal just will be completely destroyed because of the reporting requirements that you have. Here's an old article from The Economist. I just get a sense of this. This is a bill that's 848 pages long. But that's not the bill. Dodd-Frank is not a law. Dodd-Frank is a law that also requires more studies and more laws and more regulation. Dodd-Frank is 800 pages to say, go out and do these studies and figure out regulations to implement. It's not the regulation itself. And it's 848 pages just to assign bureaucrats to go out and study stuff. It's an outline directed at bureaucrats, and it instructs them to make still more regulations and create more bureaucracies. It includes 383 explicit questions for firms, which break down to 1,420 sub-questions. So let's say firms answer those 1,420 sub-questions. Where do they send them? They send them to some bureaucrats. What do the bureaucrats do? Do they read them all in detail? Do they have any kind of artificial intelligence, any kind of automated system? Who's handling all this paperwork? I remember when I started my job, I was doing statutory accounting. So you have to file it in the states, and the regulators or the Congress legislation in Texas said, hey, we got to get with the program. We got to get automated here. So they passed a law requiring us to submit, this was before the internet, submit our financials on a disk. So we submitted our financials on a disk, and one of my friends went to the state regulators, and they had this big trash can with all these disks in it. And he asked, what are you doing with those disks? We're throwing them out in the trash bin. I say, well, why? He says, we don't have the computer software to do anything with those disks. So we're throwing all 3,000 of them away. So that's the legislators, right? There's no infrastructure, there's nothing to handle it. It's just this wave of questions. How many banks are in the United States? Quite a few of them, right? And they're going to be implementing all of this. And how are the banks answering the questions? That's a lot of time. You think they're sitting down, how can we honestly answer this so that the regulators really know what we're doing? No, they're gonna use, convoluted language as well. And it also mandates 87 studies. The problem is not the reports are wrong, it's that no one knows what to do with them. What do we do now? It's smothering financial institutions. I had a friend at USA, really sharp, really a star employee. She was really good at what she did. She knew the bank really well. She decided to go part-time. So I was talking to her, what are you doing now? And she says, I'm 100% Dodd-Frank. And I thought, what a waste of a really good employee. And I thought, I didn't tell her that, but it's like, oh, because she could have added a tremendous amount of value at that bank, and she did during her career. But doing this stuff, I just couldn't see. I know USA got hit in the news pretty recently, right? So maybe they needed to hire her back. She's probably retired by now. It encourages efforts to game the system. Obviously, the cost is staggering. Banks are sacking employees and operating roles and hiring people in these kind of roles. This article doesn't say it. Oh yeah, here it is. This is pretty interesting. The law that set up the US banking system was 29 pages. The Federal Reserve Act of 1930 was 32 pages. Glass-Steagall was 37 pages. I think the Medicare law was 33 pages. Dodd-Frank, 848 pages. I think the Affordable Care Act was over 1,000 pages. What's in this stuff? Who's writing these laws? Who's reading these laws before they vote on them? How many members of Congress are reading 848? They probably have staffers that are doing it, right? But who's reading 848 pages?
They don't.
No.
Same thing with like the budget bills. It's like 1,000 pages and they only have 3 hours until it goes.
It's
How are
insane.
they gonna read it?
And a bunch of those 848 pages were probably copy and pasted from some other law that they're just throwing in there. It's absolutely ridiculous. My mom read my mom got something sent on the Affordable Care Act, and this guy had this really fancy looking video talking about how horrible it was. And so I was watching it, and I actually went back and tracked it. Like nothing in the video was actually in the law. He just made all this stuff up. It looked really good, really scary stuff. They're going to come to your house and shoot you in the leg so they can get more health care out of you. Is that, Mom? I don't really think that's going to happen. And just horrible, but no one's going to sit down and read all this stuff. And so it's really easy for someone to come in and say, can you believe that they have the right to take money out of your bank account anytime? It's like, no, Mom, that's not what it says. They just copied and pasted that from the ACH law. I mean, that's all that is. But anyway, so Dodd-Frank has obviously capital requirements. If you're going to interview with a bank, really important to understand bank capital requirements, the Basel Accords and all of that. But how much net worth? The US banks have been doing really well on that. US banks are very well capitalized, probably more so than European. Leverage limits, there's that word limits, but how much debt they have, which is obviously closely related to capital requirements. Liquidity requirements, I don't know how they're worded, but liquidity was a big thing you were seeing in your banks as well. Some of you might go back to your bank's annual report and just search on the word Dodd and see if it's brought up at all in there. Resolution plan, what happens if things go bad? What are they going to do? Concentration limits, again, a lot here on credit risk, obviously because it was mortgage backs that went under. Contingency capital, you don't have enough capital, what are you going to do? You're going to issue stock, how are you going to get more money in? More public disclosures, overall risk management requirements, kind of making sure they have the right tools and committees in place. So the question is, does it address too big to fail? And I think the bigger question is, since Dodd-Frank was written in response to 2008, would 2008 have happened if it had been in place in 2006? And most people say probably not. There's a book I recommend that I really think is quite exceptional. I think I showed it to you earlier. Let's see if I can find it here. it's the most boring sounding book on my reading list, but this one right here, Regulating Wall Street, the Dodd-Frank Act. It's interesting, this book is about the Dodd-Frank Act, and it's about half as long as the Dodd-Frank Act. I think that's kind of interesting. I really like this book. I say only for finance majors, but boy, I do like this book quite a bit. It's written by the New York Stern School of Business professors. Someone gave them a 3-star, but I would have given it 5 stars. Doesn't sound very interesting, but they actually go in detail, not just in Dodd-Frank, but they actually critique what they think they could have done better. And I think that's really the strength of this. This is, here's what they said, they could have done this. They talk about the too big to fail. They talk about other things. And they also, this is the group that set up the website that you can go in and put your bank in and see how your bank would have scored. They argue there's some things that Congress could do that would be far simpler and far more effective in identifying trouble banks than what's in Dodd-Frank. It does raise the question of who actually is writing these laws. So it's not congressmen and women. So they're hiring consultants to write these laws. Who are the consultants? What's their incentives? What's their knowledge? Obviously, they're very, very knowledgeable people, but what's their background? Do they have an axe to grind against the banking industry? Are they coming from the banking industry? So the advantage of this is coming from professors who might be a little bit independent. How many pages is it? I never know where they put pages on here. There it is. So yeah, it's not quite half, but it's much shorter than Dodd-Frank Act itself. And it's written actually very well. It's not dry. I think I found it pretty interesting. Yeah, someone try it and let me know. Maybe I'm recommending a really bad book, but I thought it was pretty good. It's now Damodaran, y'all all know Damodaran from New York. He's not in this group, so he didn't write this book. So, and I don't know these other people and what their background is, but really good way to think about these type of risk, and especially these last 2 questions. Would it have actually worked? Which I think is a perfectly legitimate question. Where's Dodd-Frank today? I don't really know. I haven't seen an economist had several articles on it, probably for a year afterwards. I'm not really sure now where it is. These regulations tend to kind of just, over time, what happens, you think about regulators, Paul Krugman, his argument was we need more regulators, we need more regulators. I've dealt a lot with regulators. I don't want to sound insulting, but regulators make a small fraction of what the people working for Goldman and Morgan Stanley are doing. So either you're talking about people that weren't really successful in finance and that's why they're taking their jobs, or you have someone who's willing to take a 90% cut in pay because they're really adamant about bank regs. The regulators I dealt with from the SEC, the insurance, and the banking side, they were not that knowledgeable. Many of them were 20 years behind time. They're not, if they were much more competent, they'd probably be working for Goldman Sachs making 7 digits. I mean, it's just, so the only way regulators are going to solve all this is like governments are going to have to start paying people $700,000, $800,000 to be a regulator. And I don't think government's going to do that. I mean, would you want to be a regulator making $70,000 a year when you could make $700,000 at Goldman? I mean, and it's not that, you're greedy, but the job at Goldman is probably a lot more fun and a lot more interesting than the regulator's job. So it's, from that standpoint. And so what does a regulator do? Well, the last thing you want to do is offend the banks you're regulating. So there becomes this kind of, wink, wink, I'll overlook this if you hire me a few years later kind of thing. So we call it regulatory capture over time. Regulators tend to kind of become more pro-business over time. So who knows if this stuff will actually work or not. Obviously, Congress had to do something. They had to move fast. They got this 850-something page bill written. Why? Because they found some consultant that already had something drafted and just threw it all together. I kind of get an impression that they could have just gone to these guys, wherever that was. They could have just gone to the New York Stern people, and they probably could have written the law for them pretty quickly. But yeah, it's kind of scary, always question is, does democracy at some point just start falling apart from complexity? The world just gets so complex and it's just too complicated for governments to handle. I don't know. I don't know if we're there or not, but it's sure is scary to think what our Congress is trying to deal with. All right, let's talk about tax risk. So let me give you a scenario here. So this is what I faced. Oh my word. So pretty simple. So 2008, I want to hedge our stock portfolio. Pretty straightforward. I'm going to hedge a stock portfolio. So how am I going to do it? So let's just, real simple. I'm going to buy out of the money. Just can't get much simpler than that, can you? Piece of cake. Really, really, really easy. Let's do it, right? So the market falls 30%. Stocks fall 30%. So maybe that's it was a small portfolio. So let's say we're off, so we lost, say, $400 million. USA was not that heavy in the stocks in 2008. So we lose $400 million, and our puts gain 350 million. So we're pretty happy, right? We covered our losses, really lost a little bit. We actually took the puts off in November, and then the market came up, so we actually ended up with a gain at the end of the year. But looks pretty good, right? You're really, really happy. So I go talk to the tax department. What does the tax department say? Any guesses on this? So the puts are taxable, right? What kind of gain is that? So the puts are a short-term capital gain. They get the highest tax rate. And I'm like, but that's fine, I got these losses. So I say, but offset the losses. What does the IRS say for that?
That's too bad.
Huh?
That's too bad.
Well, too bad, why? How do I get that $400 million loss?
Isn't that unrealized though?
Yeah, I have to sell, well, and sell. Realize a loss. The problem is that's going to be a long-term loss. It's going to have a different, I don't know what word I was putting there. Then, so sell and realize the loss. Well, I don't want to sell them because we got a stock portfolio. So I'll say, okay, well, okay, I'll sell and buy right back. What does the IRS say for that? That works, right? I'll just sell them. So it's a $1 billion portfolio. I'll just sell it. I'll buy it back. I got my realized loss. IRS says, no, no, no. That is known as what? A wash sale. What's a wash sale? A sale that you do just to generate losses. The IRS says you cannot rebuy for 90 days. Wow. All right, well, that's kind of a problem. So I'll say, I know what I'll do. So I'm real creative. I'm talking to this guy, I forget, oh, what was his name? Kevin in the tax department, really sharp guy, boy. He came to me with a 16-page report, and he liked my approach. I said, let's go to the extremes to understand this. The stock market falls 30%, stock market rises 30%. I didn't realize I was actually telling them the actual market for that year. And let's walk through the scenario. So I said, I know what I'll do. I'll sell my S&P 500 portfolio, and I will buy 50% growth and 50% value stocks. What did he say to that? Still a wash sale. So then I said, I know what I'll do. I'll sell the S&P 500 and buy 40% growth and 60% value. Then I can say, I'm not selling this for the losses. I'm selling this because I want more value than growth. This is a reallocation. What did he say? You are under oath in court. What are you going to say? That's the last thing he said. Are you going to say, no, I didn't do that to get the losses. I did that because I was want to rebalance? And what's the truth? I was doing that to get the losses, right? Am I going to go and lie under oath that no, hey, we just really like value stocks? I even asked, what if I do 100% value stocks? He said, you're going to be on trial. They're going to ask you, why did you do this trade? And you're going to have to admit why you did the trade. So it was really, really painful. So what we finally came up with is, this is it. This is our entire strategy. Let's talk in November. That was our strategy. And you know, it happened exactly like this. This is what we had. And it ended up not mattering. So anybody want to guess why it ended up not mattering? It was not an issue. I mean, it looks pretty bad right here, doesn't it? Anybody want to guess why in 2008 this did not matter? Any guesses? So the reason it didn't matter is we had so many losses everywhere else. I had plenty of places to offset that 350 million bucks. So fortunately, or unfortunately, we had bond losses, we had losses everywhere. So, I mean, it's a horrible year, right? So it wasn't like we're going around, hey, someone lost money somewhere. It's like, no, we've lost money everywhere. So it was, yeah, it was quite horrendous. So it ended up not mattering. He just wrote it off against, you know, we had billions of dollars, you know, my puny little portfolio here. We were like, who cares? We lost $2 billion in our bond portfolio. You made us 350. Why didn't you do a better job? I did cover my stock portfolio pretty well, so I wasn't responsible for the bonds. But if that hadn't happened, if the bonds had been fine, and this is all we had, I'm not sure there would have been a solution. We would have paid tax on the 350, and we would not have had any tax offset on the 400, and it would just been. So my hedge would have been wrong by about $100 million. It would have been off of. So instead of saving the company 350, I would have only saved them maybe 250. We would have had an extra one. And then my boss would say, I thought we were hedged. We were hedged before tax. We weren't hedged after tax. And so it's that was so irritating to me. And there is nothing in tax accounting about hedge accounting. The IRS doesn't do that. Why? Because so many people have abused the system in the past. The IRS fixed it for the abusers, but also destroyed it for the people who are doing this for, I think what we were doing is perfectly legitimate. We should have gotten that offset, but because someone else messed it up, we couldn't do that. So you got to be careful about taxes. Hopefully the firm you work for has a really good tax research department like USAA had for when I was there. So the treatment of an investment and a hedge can be messed up, can be because of the timing. That was my problem, right? I had my gains this year, but my losses were not going to happen for several years in the future. So it's a timing, you can't get it lined up. It can be the character, whether it's normal earnings or capital gains or short-term or long-term, that can be an issue. I've completely lost track of the tax rules since then. I knew it at that time because I was right in the middle of it, but they keep changing the tax rules on capital gains versus dividends. And then it can be the sourcing, whether it's a US or non-US gain or loss, that can be a major issue as well. And you gotta consider, I didn't have the sourcing issue because everything I did was all in the United States, but I did have the timing and the character issue. So the IRS rules are, I don't know what the tax code's up to now, 10,000 pages or something. But fortunately, I mean, this guy, he knew exactly what he was doing. I really trusted him. I could tell he knew what he was talking about. There's people who want to do that, right? Be tax accountants their whole life, and boy, they're good at it. So yeah, I wish I could find him again and tell him I'm talking about him in my class. How do you measure this? Exactly what we did. You go to the extremes. You always, and I'll say that over again. Extremes is where you understand these kind of things. So assume the stock market crashes. What happens? What does this look like? How do you mitigate it? Go to your tax department. Go through all these scenarios. You can actually go to the IRS and get an opinion in advance. It's not always the force of law, but usually if you go to IRS and say, hey, we're really worried about this, how are you going to treat it? We're going to assume it this way. Will you actually interpret it that way? They will issue you in writing an opinion that you can somewhat rely on. They can later change their mind and go to court and all that. You probably won't get criminal penalties, but at least you have some confidence that they'll rule in your favor. I never did that. We were pretty sure on this that they were not ruling our favor, so we didn't try that. There are some accounting firms that have gotten in a lot of trouble, even criminal trouble with the IRS for proposing really stretchy things on their taxes. And they didn't go to the IRS because they knew they were on the edge and they didn't want to really test it. So, it's kind of frustrating, kind of irritating. All right, operational risk. This one is a catch-all. Any questions on tax, legal, or disclosure? Is this making you more excited about a job in finance, or are you like, wow, I didn't realize? I kind of like this stuff. I mean, it's this major issue. You've got to get all the parts to work together. I loved it. You have your project plan. You're thinking of everything you can possibly think of. You're going to every department. I actually kind of loved it. They always tease me like, man, we always dread when you show up, but I think they actually enjoyed it as well. I was like, yeah, we're going to get together. We're going to think of something. So I liked it. I think I'm going to skip operation and come back to it because it's kind of a lengthy discussion. I want to jump to my least favorite of all. Well, purchasing power and then my least favorite, which is currency. So purchasing power risk, obviously right now, that's a big issue. That's the risk that inflation takes off and causes you issues, mainly because your inflows and outflows have different impacts when it comes to inflation. Inflation risk can be addressed using value risk. One of my first times to do value risk, I did it on an inflation project. So we had a firm came to us with an idea and they wanted to charge us a certain amount. It was an inflation product. So I just set it up in a simulation. And with inflation, you got to be really careful with inflation. I don't know if y'all know this term. I don't know how to spell it. I'm going to serial correlation. Is that how you spell it? Y'all know what serial correlation is? I don't know what y'all had in your stats classes, but that something's correlated with itself over time. Inflation is serially correlated. Inflation doesn't go 2%, 8%, 1%, 4%, 6%, like the stock market, right? It's not this random thing. Inflation is somewhat related to itself. And so when you model inflation, I had to actually model inflation to say, okay, next year's inflation is 60% correlated to this year's inflation. 2 years out is 30% correlated to this year and 60% correlated to the next year. I had to do that. So when the simulation ran, I didn't have a true just random process. And that's pretty important for inflation because you do get in these inflationary cycles and that's part of the risk that you're monitoring. So I had to set that up. Didn't know what I was doing, but USAA has some really good PhDs that I could go and sit down with them and how to set up the problem. And so I ran through like 1,000 simulations and I looked at the product and I said, I went back to him and said, the most anyone would ever pay for this is like 10 basis points and you're charging 100. Why are you so overcharging us? And they said, because we didn't think you'd go out and actually model it. So I was like, well, we did. So we want to test and see, because you don't want to just pay 100 when you should be paying 10. So you can do, and that was a value risk type of analysis to try to look and see when does this product pay off? And it just didn't pay off enough. It wasn't that valuable to us. So stochastic value risk is a perfect one to use with this. I don't think historical value risk would work all that much because of that serial correlation. You know, once you get into an inflationary environment, maybe you could do historical if you did it over like 100 years or something to try to get a sense of what kind of spiral you could get into. So how do you mitigate it? Obviously, we think about gold. Definitely gold has a negative correlation to US dollar, positive correlated to US inflation, but I would test it. Actually go and see, are there times gold doesn't appreciate as much as you might think in an inflationary environment? You know, so think through that. There are other things that affect gold besides just inflation. There is a supply and demand of gold, right? People are producing gold, people are demanding gold. So there is a supply and demand equation that's on top of the inflationary environment. Right now, a lot of gold is produced in South Africa. There's a lot of mining strikes, those kind of things that can affect the supply side. There's things like that you got to take in consideration. But definitely the US dollar, if the US dollar is weak, what does that do to inflation in the United States? The weak US dollar does what? What's Russia experiencing right now? Ruble, very inflationary, right? Imports are much more expensive. So there's definitely a tie there. Gold definitely goes up when the dollar weakens, but it's not exactly the same every time. So you do need to look at it over time. Commodities can be an inflation protection. They certainly did well in the 70s, no question. They were what were driving inflation in the 70s. So oil, timber, that can work really well. They're definitely positively correlated to inflation, but they're not as strong as gold because commodities tend to be production assets. So they are sensitive to the production cycle. So you have to be careful. So yeah, oil does well unless the economy is tanking and people aren't driving, so even though inflation may be going up, real estate might be a hedge for inflation. You got to be real careful. So I think I talked some on this. They created an inflation 401k option. And I was asking the guy what he put in there, and he said he put REITs in there. I don't think REITs are a good inflationary protection. And the reason for that is, what's the first thing you think about with REITs? They're small cap, but what else? So let's put a REIT in there. I don't know, a good one. Boy, I can't think of my REITs. I guess we can use the Alps REIT. I don't know what that is. Yeah, that's not the one. What are you expecting right here for a REIT on the yield? What do REITs give you? Because they're tax-free. Why are they tax-free? REITs don't pay any tax as long as they do what? Pay high dividends. So if I could find a really good, is it Plum Creek? Boy, I don't know my REITs anymore. I can't think of any REITs. There's got to be one out there. I cannot think of a single REIT off the top of my head. I'm sure there's. Okay, let me do this. Largest REITs. Not American Tower. That one doesn't count. So let's find here. Let's try Crown Castle, CCI. All right, so that's a pretty good yield, isn't it? It's not as high as I'm hoping for, but 3-4% yield, that works really well. Because they have such high yields, they become bond substitutes. There's a lot of people who buy REITs instead of bonds. Well, what does that mean when interest rates rise? REITs are going to tank when interest rates rise because people are buying them as they have duration. REITs actually, you can actually calculate the duration of REITs. Their prices are sensitive to interest rates. Well, when do interest rates go up? Well, inflation goes up, right? So I think you got to be careful. Don't just assume, and that was the thing they did. They just assumed, well, REITs buy real estate protects you from inflation. So let's stick REITs into an inflation. If you actually go out and run the correlations, I think you're going to be kind of shocked that they don't. So utilities, REITs, those stocks that are known to have high dividend yields, they tend to be very, very sensitive in the wrong way to inflation. So don't just assume, always test your assumptions. Go back with historical data. That would have been an easy one to have tested. You got plenty of data. REITs have been around for a good 50 years. You can go back and get the data and see how they actually correlate with inflation. Cash and short term, yeah, they tend to do well, but right now, CDs or savings accounts are still not paying that great. Inflation's up to what, 10%? Is your savings account paying you 10%? My guess is probably not. It's still not even paying you 1%, right? So that may not be all that great protection. Tips is the obvious thing. but tip yield right now are negative. That's the other question I had for this guy. This poor guy, he was kind of wishing I'd stayed away. But I didn't want to stress him out. But he said, well, we put REITs and tips in there. And I said, well, tips have a negative yield. How can you buy something in an inflation fund that is going to guarantee that you underperform inflation? You can get a negative yield plus inflation, which means you're guaranteeing them that they will underperform inflation, and you have an inflation protection fund. That seems kind of bizarre to me. And the other question you might be really curious in is, how do tips perform in inflationary environments? You might be shocked on that as well. When tips came out, no one knew how to price them. So they were this really volatile thing that kind of went all over the place. And you might discover that they didn't have a really good correlation with inflation when they first started out. It was kind of unusual. There are real return funds. I think we talked about those before, didn't we?
Yeah.
And how just horribly they performed historically. So real return funds tend to be T-bills plus some spread, like 6%. So T-bills plus 6% plus 5%. They just have not been able to accomplish that. Derivatives, there is a such thing as a CPI swap or a CPI derivative, but they're very thinly traded. There's not much money there. We got really excited about them at USAA until they told us how much market there was, and it wasn't large enough. And I doubt even retail investors would get much out of it, because I don't think the pricing would, I think you get ripped off in the bid ask pretty badly. And why is that? Well, for a derivative to work well, you need a hedger on both sides of the transactions. With interest rates, that works kind of well. There are people who are worried about interest rates falling, and there's people worried about rates rising. So you have kind of natural hedgers on both sides. Inflation's kind of tough. It's kind of hard to find those people who are worried about inflation falling. They do exist, governments and others, utilities even possibly, but most people are worried about inflation rising. So you have too many hedgers on that side versus the other side. Usually derivatives don't work well if you have hedgers on one side and speculators on the other side. It usually doesn't provide a very good derivative. And so they're thinly traded, but they do exist. You could research that. Currencies is possible, because if the US dollar is weakening, then you're protecting yourself a little bit from inflation. We did that at USAA in the pension plan. We did put about 10% in non-US bonds with that thought that if US dollar is weakening, probably inflation, that's going to protect us some from the inflation risk. But if inflation is rising around the entire world, the entire globe, US dollar may not be weakening, because you just have inflation everywhere, and in that case, you don't have that protection. You can hire a currency overlay manager. And essentially what you're doing there is saying, hey, actively manage our currencies. And what a currency overlay manager is, most of them have a master's or PhD in economics. They know inflation. They watch central bank policy. That's what they're watching for, is inflation more than anything else. So they may have some expertise there. That's what we hired at USAA. We hired a currency overlay manager, and we only had 3 currencies. So it made it kind of simple for them to watch out for us. And he was a PhD in economics, really smart guy. I don't know how he did. It was a really small portfolio, so I wasn't monitoring it all that closely. But currency risk is a difficult one to manage. I mean, purchase power risk is a difficult one to manage, just because there aren't really good hedging techniques out there. And gold, you're not going to put 100% of your money in gold at any time. 10% probably the most you're going to do. So it's not going to provide you, even if it does exactly what you need, it's only going to be a fraction of what you need. So it's a little bit difficult. What are firms doing today? Well, their cost of goods sold is going up. They're just hoping they can raise their prices. Are y'all noticing that? I still haven't noticed inflation. I never buy gasoline, so maybe that's why. Is that the only place you're noticing, or are y'all noticing inflation other places? At the grocery store? I haven't noticed at the grocery store yet, but maybe it's there. I budget $400 and I spend $350, and that's been the case the last several. So maybe it's the stuff I buy just not going up. But what are you noticing at the grocery store going up? I mean, wheat should be going up, right?
So I eat a lot of red meat, so red meat's gone up. It's gone back down a little bit, but still higher than what it was before. Eggs.
Eggs, I don't buy eggs.
Milk.
Well, is it everything or is it just a few things?
Not, well, I mean, I don't buy that much stuff. I buy like pretty full ingredients. I don't know about every little thing, but.
Yeah, it probably has them. I just don't notice it because it's not something I do a strict budget on. I think I would notice the gasoline if I bought gasoline. I haven't bought gasoline in months, so I haven't noticed that so much. I am making fun of my friends on Facebook every time they say, wow, the gas station, you've been in the gas station a while. I'm like, what's the gas station? Is that where I take my Prius Prime to buy sodas? So I'm kind of mean to them, but all right. My least favorite of all. Let's finish up today with, oh, I hate this topic. I hate currencies. For some reason in my DNA, it did not get the currency gene. I don't understand currencies. I always tell students I bought a sweater in Germany in marks and I divided when I was supposed to multiply, and I thought it was $100 sweater. It was a $500 sweater. I was just a little chilly because we were outside and it was chilly. I didn't really need a $500 sweater. It's a really nice sweater. I still have it today, but I just do not like currencies. But what is currency risk? Obviously, currencies change. So if you're entirely in US, not really a big deal, right? Your currency risk is part of inflation. US dollar is weakened, so you got inflationary risk. But if you're doing business in more than one currency, your revenues and expenses, your liabilities, your assets, and that's where GAAP accounting gets so complicated, is they have transactional types of things, and then they have translation types of things. So transactional things, they want to say, how you have these revenues, you have these expenses, let's try to match them up in the currencies you're in. If it's a translation thing, you have an asset that's just sitting there. Well, it's not transactional, so we're just going to reprice it at the end of year. So if it's transactional, you got to reprice it throughout the year with multiple currency rates. If it's translation, you just reprice it at the end of the year. But then the big question is, what is this? Is this a translation or is this a transaction? Do I need an average currency rate? How closely do I match it up? The accounting is really quite complex. How do you measure it? The best way to measure it is value at risk. You run simulations using currencies and other kind of things. And we have some pretty good currency modeling out there that can work pretty well. I don't really think purchasing power parity is going to help you much. Just because your currency is expensive or cheap, the Swiss franc has been expensive forever and ever and ever. It's just hard to use that type of analysis and really rely on it because it just doesn't correct all that quickly. But there are pretty good modelers out there that can do a pretty good job of letting you see your currency risk. So look at history, obviously. Look under different environments as well. Look at the 70s, the 80s, the 90s, different environments, try to get a sense of what's going on here. How do you mitigate it? Well, fortunately, here's a place where we do have really good securities. The currency market, especially the swap market and the fruit futures market, is very liquid. It's massive. It's trillions and trillions of dollars. Works really well. What's the downside of this is GAAP accounting. So you might have an economic hedge that works great, but the accounting doesn't show it. And this was my issue. So USA had this line on its balance sheet. It's this little bitty line under net worth. It was tiny, minuscule, but it had currencies in there and two other things. And one day that number was negative, like negative $2 million. I'm talking about a $20 billion company. And this line was negative 2 million. The CEO saw that. He goes, what is that? And they said, that's currency losses. He says, we can't have currency losses. It's like, it's $2 million. I was like, why didn't y'all just hide that in another account? But anyway, so it shows up on my desk, Ron, you got to hedge USA's currency risk. And like, you're asking the stupidest person on currency risk that there is. You could find anyone to do this. There's some 5-year-olds out there that can do this much better than I could. So anyway, it shows up my desk. So I'm thinking economics, right? That's what you got to do, get the economic risk. So USA has people stationed overseas. They're buying their insurance overseas. They're in Europe. They're in UK. No, I guess they're not in the UK. They're in Europe. And they're in Germany. At that time, it was all under the euro, so that was good. I only had 1 euro. We did have the UK. I'm sorry, we had the UK, so we had the pound, we had the euro, and then we had US dollars. So we had revenue, we had expenses, but we also had liabilities. Those liabilities are reserves are going to pay out in the future, right? So I had to figure all this out because we're getting our premiums today, but we're going to pay our losses in the future. So I need to get those premiums in the right currency so that when the loss is paid out, we, you know, if the euro strengthened, we have enough euros. So when those losses are paid out in euros, we have euros that are gaining at the same time. So it seems pretty simple, but there is a forecast to this. I got to figure out how many losses are going to pay in pounds, how many in euros, the timing of it. And then I'm going to go, and this is where I hired the manager, the asset manager, to say, hey, I need you to manage our currencies. You can go a little bit over and a little under in the currencies, but I need you to be pretty close on these. And so I had it all set up pretty well, and I thought it made a lot of sense. The biggest challenge I had was UK law would not allow me to hedge from a US perspective. I had to hedge it from a UK perspective, but I didn't want pound exposure. I wanted US dollar exposure. All right, so well, I shouldn't say this on tape. I'll probably cut this out of the video. But so what I did is I kind of just fudged it a little bit, and I made the numbers look like UK was being hedged, but it was absolutely the US being hedged. And I did it because there was such a wide range for my assumptions. So I just made it all look that way. Fortunately, I was never called to court and had to testify or anything. And we were such a small business there. So I doubted they would, but that's what they told me. You got to hedge it from a UK perspective. We can't hedge this for USA's benefit. So I had it all set up. It was great. We had it set up. As stupid as I am on currencies, I had it in Excel. So there was kind of error proof, right? Excel did all the work for me as long as I did it the right direction. And it was kind of humorous because the guy running a business in the UK, he came to US to meet with us. This is before Zoom. He was assuming I was 20 years older than I was. He wasn't expecting this kind of young kid. And he saw me and he just kind of freaked out. He says, oh, I was expecting someone a little smarter and wiser. But anyway, it's like, you're stuck with me. I'm the one managing this for you. So it worked great economically. Gap accounting didn't work. Guess what? 3 months later, there was a negative $2 million on that line. The worst day of my entire career. The CEO was lividly mad. He was ready to fire me. That's about the closest I've gotten to being fired. He was so lividly mad. He told me, you got to manage this. Now, what he told me to do, and I'm going to tell you, I don't think this was possible. Y'all can tell me. Y'all can critique his. So he wanted me not to hedge USAA. That I think I was doing extremely well, even though the accounting didn't show it. And that's when I told the accountants, why don't y'all just roll that line into another line, because it really was immaterial. He wanted me to hedge the USA member. So he wanted a USA member who was paying their premiums in euros to make sure, but they were getting paid in US dollars, right? US government, but they're paying their premiums in euros. And he said, you got to hedge them. So if the euro strengthens, they don't have any losses. So now I'm thinking, how in the world can I do that? And there really was practically no. So essentially what he's saying is, if the US dollar weakens, we need to cut their rates so that they don't have that loss when they pay in euros. I could do that, but I couldn't do that without harming whom? USA, right? There's no way I can help the member and not harm USA. I tried options, but I looked at options and we did options. It was going to be like 90% of their net income over there. So it was just not going to be worth it. It would have just been horrible. I couldn't think, well, someone came in and said, you don't need to do that because the US military has a currency adjustment to pay. I didn't know that. Y'all know that? So if the euro strengthens, they actually pay the US military more money because, so I'm like, problem solved. They said, run, problem solved. You don't have to worry about it. So I let it go. Well, 6 months later, someone forgot to tell the CEO that. He was like, no, I never, he thought I just decided not to do anything about it and just left it. That's when he was about ready to fire me. But there was debates back and forth. It was a complete rigmarole. We go to exec council meetings and someone would start talking and they get off on it again. I was like, I wish everybody just shut up. And my thing was, I just wanted to sit it with the CEO one-on-one and go through this if I could. And people kept bringing it up. It was just a mess because no one understood it. It's pretty complicated stuff. I finally got my chance to sit down with the CEO. He finally understood the side of it. He said, yeah, that makes a lot of sense. Essentially what he said was, everything you're doing makes perfect sense. Just make sure this doesn't happen again. I had no idea what that meant because I'd done everything I thought I was supposed to do. So I didn't know what he didn't want me to have happen again. But this is what you face in finance. This is going to come to one of the cases we're going to come up with when we talk about this case with MG. It's a case of finance doing what they need to do, but the people that they're working for don't understand this stuff because it's so complicated. It ends up blowing up in their faces. And I literally, my department was like, Ron, how much longer are you going to work here? They were like, this guy is gone. I mean, when the CEO is turning red in his face, screaming at you, you know you're in trouble. So it was not pretty, and it's all currencies, of course, because I can't do that. I don't think there's any way to do this. I really don't. Geico didn't do that. And that was my other side of this. What if we do hedge the member in a way that if the dollar weakens, they get a gain? Well, the problem with that, what happens if the dollar strengthens? Well, now Geico looks a lot cheaper than we do. Why? Because they're paying in euros and euros is real cheap. I couldn't find a way to get both sides hedged. I could hedge that if the US dollar weakened, yeah, that'd be fine. I could hedge that, but the dollar strengthened, boy, they're getting paid in dollars and euros weaker. Boy, they're going to go to Geico, right? Geico's going to be 20% cheaper. I could not get around. I set it up, you know, chalkboard and everything else. Plus, remember how stupid I am on currencies. So I'm already starting behind to begin with. So it was not a fun part of my career. But anyway, so nothing discouraged you from being in finance. It was still interesting and intriguing. So currency is tough because of the accounting. If you can somehow figure out a way to encourage your management just not to worry about it. USA was so immaterial, we should have just ignored it. All right, so what we'll do next class is the interesting one. I did check with iClicker. I can get it to work, but you'd have to load iClicker on your phones. So y'all can decide if y'all want to do that or not. That makes sense or not? Y'all want to test iClicker? Do y'all have iClicker on your phones? Anybody? No? All right, we'll see. If no one does it, I'll see. We'll just do it by hand. But operational risk, there's a lot we can talk about here. I find it really, really interesting. So we'll start there next time. All right, let's get started. So we got our very last risk, and then we're going to get into the readings, which I think are really good. What are people saying about risk today? Share some of the books I've read recently, some summaries of them. But this last one's a fairly long risk to talk about because it's a catch-all for everything else. So operational risk is just the risk of the way your firm is run. Just includes anything you do that you could be sued for is usually what we're talking about, or you could have fraud committed against you, or someone could steal from you or whatever. So procedures, policies, they're not followed well, they're not designed very well. There's a big loss. Essentially anything that can go wrong. Definitely internal controls is a big part of it. That's why you saw.
They're like trying to highlight something screen that's not showing.
I don't know why. Yeah, people keep, let me try it again. All right, so sorry, but so internal controls is a big part of it. You saw that with your banks. They have internal controls. You're trying to catch bad employees or bad procedures. At USA, when I was in the investment side, my first day on the job, the compliance lady came in. Yeah, sorry. Okay. I don't know why people change that and then they don't change it back. And they leave it up to us to try to figure out. All right. Great. Oops, that was it. I had it. Is that better?
Yeah, that's it.
What's showing on Zoom though, I wonder? All right, if anyone's on Zoom, let me know if you're seeing this stuff. All right, so anyway, so my first day, Stephanie comes in, she was the compliance officer or compliance person. And she came in with books this thick, 2 of them, and just slammed them on my desk. She didn't slam them because she's mad, it's because they were so heavy. She says, here's your policies that you got to follow as head of equities at USAA. And it's like, there's no way I'm going to read all this. Are you kidding me? Fortunately, Stephanie was really good at her job. So I just relied on her. I said, you tell me if I mess up. And she let me know anytime. There's one time she had to write me up for the board. I made a mistake. I think I needed like 199 options. So I bought 200. And she said, no, you should have bought 199. So I just rounded up to the nearest. So I thought, no big deal. It really wasn't a big deal, but I had to write a whole letter to the USA board explaining why I bought 200 options instead of 199. Why? Because that's what the procedure said. I couldn't overhedge even if it's by a small fraction. And that's the issue. You know, these are complicated businesses. You got a lot going on. So writing these massive policies, who's going to read it? Who's going to learn them? Who's going to memorize them? Some of y'all want to go into investments. When I went to the investment side, I shut down all of my trading. I decided never to trade a security while I was sitting there because the rules were so massive. We fired one guy just because he wasn't paying attention, did a trade. He traded a security that was in our portfolio. And you can't do that without getting pre-approval because he could have been front running. He wasn't front running. He was a telephone person who didn't even know what was in our portfolio. But because he did it, he got fired. He was a really good employee. I really thought we shouldn't have fired him, but they're like, this is the second time this happened. We know it's a sloppy and all that. So, you know, firms are real strict on this. Some of you will find firms, I've gone all over the board on this. Can you trade or not trade? At USAA, I had to get approval in advance before a trade, and then I had to hold the trade for 90 days, which I was an option trader. It's like, I'm not going to guarantee I'm going to hold the trade for 90 days. That's ridiculous. So I just stopped trading. I did all my trading in my 401k plan, which I could do all the trading I wanted in my 401k I could do without any issues at all, but I couldn't actually trade in a brokerage account. So these are procedures. Some of them I think are overkill that don't really protect much, but they just look good on paper that you can say you have this kind of stuff. So you're going to face this stuff in this business. Internal controls for me was I had to sign every trade ticket. Well, a lot of times I couldn't sign the trade ticket because I was in a meeting. So Michael signed the trade ticket for me, and then I came back and I signed it after the fact. Can you do that? Yeah, we did that. We trusted Michael to put the trade in. He's like, trust me, Ron's going to sign it when he gets back, kind of thing. Because I can't leave a meeting and come sign the trade ticket company. You know, it's kind of, although we did, and I'll give you this hint, we did use that as an excuse to get out of meetings. It's like, we got some trades we got to do today. Sorry, we can't come. And like, that got us out of some really bad meetings. You're worried about theft or about rogue traders. That's a really good book called Rogue Traders. That's really interesting. What happened with the bank in England, or even a whole system failure. Things just break down. The hiring process is full of risk. I did a lot of interviewing for USAA, and I love to ask off-the-wall questions. They said you can't do that. So you have to ask every single person the exact same questions. I was like, I don't want to do that because they're going to say I can't. If they say X, I can't ask them Y, and they say, well, you can, but you know, it's like it's real strict. It's like, oh, I don't like this at all. If they say something that brings a question that they may not understand what they're talking about, something like that, I want to just kind of say no, because what happens? You ask them this question, but you don't ask this person this question. They're going to say, oh, that's because I mentioned something about my religion or my family or something, and you use that against me, so you didn't ask that question. That's why I didn't, you know, it's just horrible. You have to, you know, it really harms the whole process. Reputational risk, some negative headline, obviously lawsuits. Lawsuits are pretty frequent. I do like when I'm interviewing for a firm or talking about a firm, just go on the Google and type the firm name and type the word class action lawsuit and just see what comes up. Every firm has them, but just see what comes up and see how major it is. I work a lot with life insurance. There are some really, really evil life insurance companies out there, and you can find it by the type of lawsuits that they're getting. If they're treating their customers well, or are they doing things that are really ripping their customers off, you'll see it in the lawsuits. Operational disasters, we'll talk about a couple of those. Maybe you're not adequately insured, or you can't be insured because you're just too large. I mean, there's all kinds of stuff. We're going to talk. We might get into some human resources one. I'm just kind of curious of your opinion on how do you measure it? There's almost no way to measure this. One thing I have used personally, which I do recommend, is this whole idea of incidents reports and close calls. So I ride my bike every single day, and I'll tell people that. I told that to my class last semester, and one of the doctors says, "Oh, that's crazy. Like, it's a really dangerous activity," and it is. It's a dangerous activity. But one thing I've used as a risk control is every close call I analyze very, very closely. And I've changed my route. So there's one road, it was getting kind of dangerous. Okay, I got to find another route because too many close calls. I'll slip in a certain spot and I go, okay, I can see the type of roadway that was. I take note of those. And so I make those changes immediately. I was hoping, one of these classes, I really would like to get someone from the Federal Aviation Administration. They're really good about the close calls. Just because a plane had mechanical difficulty, but they landed without any issues, they're still going to go in and analyze that in detail. Why did it happen? Is this something that's wrong with every plane, or just this plane? Was it a maintenance breakdown? If it was a maintenance breakdown, why didn't they follow the procedures, or they did follow the procedures? And I watched those shows. I don't know if y'all watch those shows, all the plane crashes. The ones that didn't end bad. I like the ones where the show starts where they interview one of the people on the plane, because then at least somebody survived. I prefer those versus one where everybody gets killed. But I'm really interested in their whole process of these incident reports. Why did it happen? Nassim Taleb talks about the airline, that whole industry being very good risk managers. They understand that every single accident needs to be a learning experience, needs to makes the future better. And so that's what I do with my bike rides. Every time something happens, I'm looking for something I can do to reduce the probability that it happened again. So process can often be more important than past performance, because you're talking about really low risk, low frequency events. They don't happen very often. So, but that's why close calls is really important, because a close call was almost an extreme event, but you just barely missed it. So that might be the only data you have. So someone almost fell out of the window and almost died, painting something. Well, then you say, okay, well, they got to change their safety. So measurement is tough. One problem with the close calls is obviously the department that had the close call has no incentive to tell you that, because that somewhat implies they're not doing their job well. They're not watching. So, how do you incentivize people to actually report those type of things? Mitigation, good procedures, well tested, constantly monitored. I'll give you my approach. I somewhat alluded to it last class. This sounds crazy, but what I did at USAA is I sat around thinking about how I could destroy the company. And I would just sit there. What could I do? Could I pick up the phone and make a phone call that would do major damage to this company? Because one employee shouldn't be able to do that, right? So if I could actually do that, if I could pick up the phone and say, hey, I want to do this trade, and I'm knowing that trade would be horrible, I need to change the procedures. So I found that really powerful. I mentioned it last week when internal audit came in and said, what if Michael's out sick? And I'm like, well, what if I do this trade? They're like, oh yeah, that's a lot bigger. So what I did is I sat down, because I got USAA in the options kind of big time. I really like options, and USAA hadn't been using options, so I want to do options. And their approach was, oh, that's fine. It's Ron. We know Ron. He won't do anything wrong. And they just let me have it. It's like, are you guys crazy? What if I have, bad breakup, or get mad at somebody, or my boss says something, and that's like, I'm taking this whole firm down. They didn't know me that well, right? People can snap. Perfectly reasonable. They should not have put that much on me. Plus, who's going to replace me and all these kind of things. So I sat down and figured, okay, what could I do to destroy this company? And then I set up procedures so I couldn't do that. So in every option trade, Silas, who was over in the compliance department, he had to look at it and make sure it fit what our strategy was. And then he would have to send an email explaining that we saw this trade, it's fine, it's within constraints. There's one day he didn't do that. So I called him, go, Silas, where's your email? He said, well, we're really busy today. I said, no, you have to do this. So I was kind of mean to him, but it was like, you have to do this. This is really, really critical that you stop what you're doing. I remember one time I did a trade and they emailed me, the broker, and I had bought something and they told me that they had sold for me. So I didn't short that security. My heart rate was like, so I thought they went short when I would said go long. And so I'm about to panic. I'm picking up the phone and like 3 seconds later, a new email. Sorry, we meant to say buy. We said sell. And it's like, okay, that's kind of freaky. So I did that. And then I went to the CFO and told the CFO all of that. So Joe, did you realize you gave me this authority and no one checked? I wanted him to know that, I thought that was pretty dangerous for a firm as big as USA, right? Y'all agreed one person at USA, even the CEO, should not be able to pick up phone and destroy the entire company. Wouldn't you think? That should not be possible. A firm that sophisticated. I mean, essentially, that's the AIG story. What was it, maybe 2 or 3 employees brought the whole thing down? That's pretty scary to think that much power resides in just a few hands. The reason it's so important on the investment side is that we've created these weapons of mass destruction that are very levered, like futures and options, that our management don't often understand. They don't really realize how dangerous this is. Because when you think about it, with a swap, remember an interest rate swap, you enter that transaction, it goes on the books at 0. There's nothing there, so they don't even notice it. They don't notice it until it starts moving in price. And what you'll discover with management, a lot of times, if you're doing something complicated and you explain it to them and they have no clue what you're talking about, they'll pretend like they understand you because no one wants to be embarrassed, especially the management. And so a lot of times they'll say, yeah, that sounds good. Yeah, let's go do that. And they're like thinking, I have no clue what they're saying. So, you have to somewhat monitor yourself and just stop and think, what did they just allow me to do? And should I be allowed to do that? Should there be more compliance here? So think about it. I doubt, in my first 5 years of my job, unless I just brought a can of gasoline and matches and just try to burn the whole place down, I don't think I could have done much damage. And even there, I think the whole sprinkler system would have shut it down. So I don't know what I could have done as a new employee. But as you move up in the company and you start getting more and more power, you start asking that question, should they have given me that authority? About the accounting perspective, y'all, well, I don't know if you had an auditing class, but internal controls are either frequency focused or severity focused. Frequency focus is on prevention. We're going to keep this from happening. So a lot of controls you'll see is before the fact, some kind of documentation, make sure this trade was actually authorized before it takes place, those kind of things, signatures, those kind of things. And then there's some that are severity focused, that's detection. So the loss has already happened, but we're going to try to catch it early enough so it doesn't get out of hand. All right, so that's somewhat of the rogue trader with Nick Gleason of the loss was there, he had losses, but the company didn't do anything about it. And so a $50 million loss became 100 million, became a 300 million, and ultimately brought the entire bank down because people weren't, they could have caught it early, and it really would have been a pretty small thing, but it just got out of hand. And there's a lot of examples of that. And then what kind of controls? A big one for me was authorizations. So you say, you can't do a trade unless this person signs. Who has the authority? How much authority should they have? Dollar limits. When you get to become portfolio manager, there's really not much constraint. If you've got a $10 billion portfolio, you can trade $10 billion if you want to. I know $1 billion sounds like a lot of money, doesn't it? But how big is BlackRock? Aren't they? They're getting, well, who knows? They probably have come back the last couple of days. What's the AUM? Assets under management. So they dropped down a little bit, but they're getting close. Last time I saw them like at 9.8 trillion, $9.5 trillion. $1 billion is right there, right? It's just a really, really small number. So now I remember the first time I did $1 billion trade on the phone, I'm thinking, wow, this is amazing. I thought, wow, I'm real powerful. And then I'm thinking, wow, it's Barclays does that like every day 1 million times. It's like no big deal. But it is a lot of money, right? $1 billion is a lot of money, and you're having one person pick up the phone and move $1 billion. There better be some controls in place that they actually have that authority. And then review after the fact. That's what I was pushing. Let's have someone, okay, I did a trade at options. That can be pretty dangerous, probably okay during the day. It probably won't move that much, but over a few days, if someone doesn't review it. So let's have someone review it after the trade. So that was somewhat of the detection. Did he go long on the trade when he's supposed to go short, or short when he's supposed to go long? And is the notional amount, does it match up to the portfolio? If it's a $3 billion portfolio, was the notional amount $3 billion or less, that kind of thing. I know when I trade like with Schwab, it's all on the system. So if I trade too many options, the systems wants to just tell me you can't do that. So a lot of it's built into the system. So that's good. That protects them. Documentation, paper, electronic communications. I'm not sure how great that is. At USAA, it was massive amounts of file cabinets with all these trades sitting in them. Who's going to look at that? I'm sure internal audit probably went and looked at 3% of them or whatever, just to make sure, but they're all sitting there. We were not electronic at all. So everything we did was in paper and signatures. They probably have done more electronic authorizations now. So you want evidence of the transaction, who performed it, who authorized it, what were the amounts, when did it happen? And then reconciliation after the fact to make sure things line up. I was really shocked in my first job in accounting. I started looking at these accounts, and it's like sometimes they would hit this account, sometimes they would hit this account. And I was just knowing it's just a mess. So I thought, well, I'm an entry-level accountant. I'll go through this. I went back a few months, went back a few years, went back many years. I finally went to the CFO and said, Susan, we just need to write these accounts off because there's no system, there's no process all over the place. We just got to write them off. The net was really small, even though they're all over the place, but it's like, it's obvious to me, as an entry-level accountant, it's obvious we should be using the same account every time, but whoever's doing the entries doesn't know which account. So you have, a series of 12, 13, 14 liability accounts, and they're just a mess. And so no one was reconciling them. I won't ask how many of you reconcile your bank account. I'm assuming it's every month at least. Everything I do is in Excel, so my Excel automatically does all of that. It's all tied together. But you need to do that. I was working with my mom on her checking account. We finally just gave up. Said, what's your balance? We'll start over from scratch next week, and just whatever you have, don't write anything. Let's, let everything clear. Let's see what you have, and then we'll start from there. So reconciliation is important, checking your credit card accounts, those kind of things. A lot of people don't do that even today with all this electronic fraud. And then security of assets, security of records, physical, administrative, technical. So just making sure things are not sitting out there in public that anybody can take them. Separation of duties is one we rely on a lot. Separation of duties doesn't work if you have collusion, obviously, but it tends to work fairly well. But there's a lot of cases where, you had separation of duties and the two people that were separated duties, they colluded together. Sometimes this doesn't work. I've worked with some small entities, and separation of duties is impossible. There's one entity I was working with. It was a church, and I was helping them set up their new accountant. And so I went to the bank and said, I want to see the signature cards. So the bank said signature card, and we looked at what we had, and they said any two church members signing is authorized. So well, they have like 1,500 church members, and one of them is the bookkeeper and her husband. That means the bookkeeper and her husband can sign our checks, and then she does the bank recon and she does the accounting. And I'm telling her this thinking she's going to be real offended that I'm, questioning her. And she's like, no, this is terrible. We got to get this fixed. I was really glad. Her reaction was, we got to get this fixed, because if anything goes wrong, I want to make sure everything's ticked and tied, that they don't come to me first. And so she had the right attitude. So we changed our signature card and said, only these people can sign, and our bookkeeper cannot sign our checks. But you might be surprised. You work with some small private school or something like that. You may be surprised. They're completely relying on that bookkeeper to be the most honest person. You've heard the stories of bookkeeper, what, stealing $1,000 a month for 20 years kind of thing. And it's just hard. It's hard to have separation of duties when you don't have one person doing everything. But there are things that you can do. One thing we do with them is the bank recon. The bank recon to me is extremely important because the bank statement's the one outside entity that we have that confirms. So someone who's not related gives me a number. So bank statements are extremely important. That's what happened with Nick Leeson. In his trading, he was hiding all of his trades in a fictitious bank account that he created, and no one ever looked at that bank account to see if it actually existed, didn't look at statements or anything. And he said there was $300 million sitting there. You would think a $300 million bank account, some auditor would go and see if there was actually $300 million sitting there, but no one ever bothered to do that. So separation of duties, if you can't separate duties, then at least find someone to get a third party to confirm some kind of statement or something that says what you have. So I love this Glenn Holton article. I won't make you read it. I just want to summarize it. Glenn Holton is a famous risk manager. I don't know how old he is. He's been around a while, and he has written some really, really good articles. He's got I mean, let's look at the name of his website, Risk Management. There he is. I don't think that's a recent picture. How to calculate value risk step by step. That sounds interesting, doesn't it? How to start a new risk management job. Is risk management a job or a career? I don't even know what that means. Fooled by black swans. What the 4 T's overlook. I don't know what that means. See all articles. So he's a pretty good guy. Writes very, very well. He's a professor, so that makes him even better. Defining risk is actually my favorite thing that he's ever done. When I was over investment strategy analysis, our staff meetings, I would assign them articles and we discussed the articles. Boy, they hated that. I loved it. It's like, we got to be reading. And they're like, this is one of the articles I assigned to them. They hated it. They think, why did you make us read this? I love this article. What I love about it is this is a guy who makes money doing risk management, and his very last paragraph essentially destroys his entire company. What he's asking is, can we measure risk? That's what he does. And his answer is no, we can't. We can only measure our perception of risk because we can't measure the risk we can't perceive. And the risk we can't perceive are probably the biggest ones out there. So all we can do is measure the risk that we can perceive. So at best, we can operationally define only our perception of risk. A more manageable task is operationally define some aspect of perceived risk. And in this last sentence, we're going to see this with Doug Hubbard. It is meaningless to ask if a risk metric captures risk, because he says it doesn't. Instead, ask if it's useful, which a lot of people know. That's why Doug Hubbard hates heat maps so much. Says you can't measure risk with heat maps. The better question to ask is, the use of heat maps actually have any documented evidence that makes firms better? And he says it doesn't. It's actually useless. So why would a guy who makes money in risk management in an article like that? So I love it, right? He's kind of killing his own, but he gets into some pretty philosophical stuff in here. I mean, my word, he's got Knight, and he's got some other famous people in here. So Hume, I mean, he's going back to 18th century philosophy to talk about risk. So it's a great article. I do recommend this article because I actually think it's pretty good, but you probably won't like it any more than my department did. But he has several articles. I don't see his enterprise risk articles, but it was one of my second favorite of his. And the word enterprise, when you see enterprise risk management, that was a catchphrase several years ago. It even has this acronym ERM. So we were using it. It probably isn't used anymore because it got overused. But by the word enterprise, what they mean is it's looking at the firm holistically, not in pieces, not here's this risk and this risk, but look at the entire firm. And he says enterprise risk management needs to have 3 pieces. It's the culture of the firm, it's its procedures, and it's the technology it uses. Now, technology doesn't just mean computers. It really means the process of collecting information to figure this out and how this tie together. And what's interesting about this article is he's talking about these massive risks, and he's asking, why did these massive risks happen? And if you take every massive risk he talked about and added it together, Merrill Lynch lost like 3 times that in one day in 2008. So these massive risks got much more massive after he wrote this article. Do y'all know these? Orange County, we'll talk about Orange County later. Anybody remember Orange County? That was before your time. USAA is real famous on the Orange County for avoiding it. Barings Bank, I was just talking about them. That's the Nick Leeson one. Have you ever heard of them? There's actually a movie on that one. Doway Bank, y'all heard of that one? That's a bond trading risks. Sumitomo, I actually saw that one in an article not too long ago. This one trader essentially took control of the entire copper market in the entire world and was moving prices. He went into hiding. I don't know if they ever found the guy. You can look it up and see. I don't know where he hid out. But one person was influencing. So these are examples. Well, look at these dollar amounts at 1.7 billion, 1.5 billion, 1.1, 1.8. They're puny dollars compared to what happened in 2008. I don't mean throughout the year 2008. I mean like in 5 minutes on one day in September kind of thing. You know. So his question is even more pertinent today after 2008. Is why do these risks keep getting more and more massive? And his argument is it's not that people are more evil. I mean, that might be true, but I don't know, what statistic would you use? Are people more evil and more fraudulent today than they were in the past? He's saying, no, it's our instruments of destruction that we have. And he's really blaming it on derivatives, futures, options, swaps, swaptions, forwards. These instruments are heavily levered. They're very complicated. One person can do one trade that's just massive, something you really couldn't have done in the 60s and 70s. It just wasn't possible. I mean, the 60s and 70s, you couldn't even really trade. I mean, it was a phone call, all this paper, you know, it wasn't, you get on a computer, you click and you have this massive transaction happening. So he's saying it's not the people gotten worse, it's that our tools have gotten much worse and management doesn't realize it. Management doesn't realize they've unleashed their employees to do these massive things. I think this is the reason Warren Buffett is so anti-derivatives, is he just thinks, yeah, they may be good, but I can't control the downside of someone doing something really, really bad. And then no one wants to admit they don't understand, so they allow the trades. This is why I love working with the CEO at USAA, is if he didn't understand anything, he had enough confidence to say, I don't know what you're talking about, I don't understand it. One thing he did, which I think is really powerful, you might use this in your own technique, is when he had executive council in front of him, they're about to make a decision, he didn't vote. Instead, he went around and he go, Jane, what do you think? Bob, what do you think? And it was interesting, they're all about to vote yes because they knew he was for it. But when he did that, suddenly they all had problems. Now, one time it really irritated me when I was doing the pension ALM, you know, balance sheet immunization. I had it approved. I'd met with every single member one-on-one. They all understood it. They all loved it. And then about a month later, it gets presented. We're going to get it approved. And he does that, and they all go, oh, we don't understand it. And he looks at me like, you should have explained this better. It's like, I met with each one of them one-on-one. I didn't say that. I was like, no, I'll go and meet with them one-on-one one more time. Fortunately, the second meeting, he wasn't there. And the president of the life insurance company was there, and actuary, she understood it all. She didn't do that. They all looked at her and she said it makes sense. So they all approved it because she was there. But you know, I like that approach, even though it's irritating to me. Why didn't they understand it? They did understand it when I presented it, but a month passed and it's complicated stuff and it just didn't ring with them. So, but I like that. So he was willing to say, I don't understand. It didn't bother him at all. And that's a pretty powerful CEO that says, I don't know what you're talking about. And ultimately, it may not matter until a crisis. And so management's dealing with a crisis and then they discover, oh, this thing I approved over here, it's blowing up. What was that? I don't remember that. We approved that like 4 years ago. What are they doing over there? And yeah, it takes a crisis and makes it much, much worse. On culture, he says culture is the most important thing, and it all comes down to how does the firm confront irresponsible behavior? The Nick Leeson is a good example. You have this trader who has this reputation for being really good, really smart, making great trades, and he was like untouchable. The scariest part of that book is he's in trouble. He's down a few $100 million, and he's keeping this thing going by just kind of kiting this whole thing, kind of rolling it. And they call him up, their star trader, and they say, we need you to come to New York for a meeting. We want to show you off. And he's going, okay, the gig's up, because if I have to go to New York, this whole thing's going to blow up. So he calls him and says, I can't come to the meeting because I need to be able to do my trades. And they said, no problem. We've set up a Bloomberg machine in your hotel room. You can trade the whole time you're here. So he went to New York, kept his fraud going. Instead of a couple $1 million, it turns in even bigger and bigger and bigger. That's how clueless the management was of what he was doing. They actually encouraged him to keep it going. And then a lot of it has to do with your personal risk. Do you have to risk your job to point out someone else messing something up? So my approach, like on the balance sheet immunization, other things, was I would just quote regulations. Here's what the regulations say. So it wasn't me. I'm just saying, we're not really complying with these regulations. And that helped a lot versus just me thinking someone's doing something wrong. And that's where, you talk about your chief risk officer in your bank. Do they really have power in those banks? Can they really step in and say, I don't think we should be doing this, and people listen to them? Are they just there for show? A lot of banks, the traders are the ones in control. They're the ones that make decisions. They're paid the most money. They're stars. And some chief risk officer coming in saying, you should be doing that. They're like, hey, don't tell me my job. This is why you pay me. This is, I'm great at what I'm doing. And there's some truth to that. They're doing something that's so complicated. There's no way this chief risk officer really, truly understands it. But if they can't stop it, then what are you paying this chief risk officer for? And it may just be for show, so you can say you have one. It's rocking the boat, asking questions, challenging the establishment. I would check on this early in your career. What happens when you ask your boss of, why are you doing that trade? Boy, that seems kind of, I'm not understanding your risk of that. We'll talk about Orange County. You can kind of imagine with Orange County, you have someone, if he was ever questioned, would just react with this incredible just anger, like, don't tell me how to do my job. He would be a horrible person to work with in this environment. Do you have an environment where you can actually ask these type of questions? At USA, you could, if you had access to the CEO or the CFO. Joe Robles was a wonderful CFO and CEO. He was very easy to go to and say, Joe, I think we should be worried about this. And he would listen. He wouldn't let you get in trouble. And it was, so you want that kind of firm. You don't want a firm where you go to the CFO and he says or she says, you need to bring this up to the chain of command. And you're like, well, it's my boss that's doing this. Like, yeah, you got to go through your boss. Okay, well, then just forget it. I'm not going to do that. Corporate defines what personal risk you have to take to manage risk. If you've got to risk everything to manage risk, you're just not going to do it. So you need a company where individuals are making decisions. I learned this, boy, I'll give you a secret to success in finance and accounting. When I started USA, it was a committee-run company. Everything was done in committees. Boy, I discovered really quickly, there's only two reasons for committees. It's to avoid work and free coffee. That's the only reason you have committees. And it's avoid responsibility. And I discovered if you go to a committee meeting prepared, you suddenly gain all this power. So I would go to a committee meeting that had nothing to do with my job, and I would go with a draft agenda. And everybody's sitting there, what are we going to do? Where no one knows what to do. And I go, well, I got a draft agenda if anyone's interested in it. Yeah. And you pass it out and suddenly you own this project. And I would do that a lot. It was amazing. And I was getting a lot of extra overtime work, but boy, you get a lot of, which is what you want early in your career, right? You want all these projects coming to you. So you just learn a committee run organization, and then a new CEO comes up who hated committees. He wanted someone responsible for everything. So you're responsible for this, you're for that. And he said, I don't care what the committee says. If something goes wrong, you're the person that's in trouble. And a very different approach, really shook up the company quite a bit. And he would pick the person that was for each one of those things. And if they didn't like it, he would fire them and find someone else. And one thing he did not like was you hiding stuff from him. If you wanted to be fired, you didn't tell him bad news. And people didn't realize that. I remember a couple of VPs called me because I was just this peon analyst, and they called me and literally asked, Ron, why haven't you been fired yet? And the reason they're asking me that is I would say something to CEO and he would start screaming at me, and they're thinking, boy, they hate this guy. He wasn't mad at me. What was he mad about? He's mad at this bad thing that happened. He's screaming at me because he's mad this bad thing happened, but he actually loved the fact that I told him. And these other VPs, how do you do this? Well, just tell him everything that's going wrong. That's what he wants. And they just, that wasn't the way they thought about it. He was, hide it as long as you can, and maybe we can fix it. And he was like, no, if I find out you're not telling me something, you're out of here. He cut people fast. Boy, if he thought you were keeping something from him, he cut you fast. You know, I was like ready to retire at any time. So I was like, what do I have to lose? Getting fired is wonderful. They give me severance and then, you know, I'll kind of get 6 months pay. That'd be great. So I wasn't like intentionally trying to get fired, but it wouldn't have been the worst thing in the world. A lot of questioning, admissions of ignorance. Those are the kind of corporations you want to work for. And not all corporations are like that. In fact, probably a lot of them aren't. Or it may be a mix. There may be certain parts of the company that are and certain parts that aren't. You do not want to work for a company where no one can admit ignorance and there's no questioning. You can't challenge, you know, just because you're an entry-level person, they're not going to let you challenge someone. You've got to be able to question and challenge the company. Procedures then come in place, and what procedures do is reduce that personal risk. So if someone's doing something they shouldn't be doing and it's violating the procedure, then all you got to do is just say the procedure says it. Then it takes the personal risk away. But procedures really depend on the culture, because a lot of firms have procedures that are just kind of going through the motions. I think that's somewhat what AIG had at the very end before they blew up. They had these wonderful procedures, but no one was really monitoring them the way Greenberg was. So it reduces uncertainty, reduces the individual risk, so promotes action. But you really have to review the procedures quite regularly. And you got to make sure the procedures are to actually reduce risk, that you're not just doing procedures to comply with FASB or comply with rating agencies or regulatory. You start with what makes sense for you, and then those other things, you kind of fit them in. So the reason you don't want to focus on these people is their goal is to minimize risk. And that's not what you're after. You're trying to optimize risk. There's risk you should be taking because you get paid for them. Regulators don't understand that. They just want you to stop doing anything risky. So start with what your firm's all about. But I think like I said, the biggest problem with procedures is the volume of them. There's just so much, it's almost unmanageable, especially in the investment side. The SEC is it's just overkill how many procedures you have to follow. And then the technology, we have some actuarial science majors in here. They're really bad on the technology side. They love spending a lot of money on technology before they figure out why they want it or need it. Why? Because they're really good with computers. They're really good programmers. It's like, yeah, let's spend $400,000 on this new software package, versus stepping back and asking what actually we're going to do with this. And I discovered this is the most difficult part is getting the data you need in a timely manner. Where is the data? Who owns it? Who keeps track of it? How accurate is it? The people putting the data in, do they have an incentive to fudge numbers and change the numbers, those kind of things? So where is the data? Probably one of the first things you want to learn in a new job. Where is the data? That's why you got to learn Python, right? You got to learn SQL and Java. So not only where is the data, how do I get my hands on it and bring it out? More and more firms are turning that over to their employees to do their own programming and get all the data themselves. So you got to get much better at that. If you haven't learned some programming language, you probably need to start pretty fast. And every area keeps their data in a very different form. So, you know, you got to figure out how to get that automated so that you can at least collect it in a way that makes sense. You want the risk to be forward-looking. This is what that book I showed y'all last time, that was their criticism of Dodd-Frank. That Dodd-Frank was too much focused on things that have happened in the past, and they were proposing things that we could identify things early, right? You want an early warning system. What is going to tell you that this is something about to blow up? So watch for it. And then I may have given y'all this quote before. I can't remember. Did I show y'all this before? I think I did. garbage in, gospel out from the, so yeah, just because everything looks complex, there's all these bells and whistles and lights flashing, doesn't mean that it's any good. Now that's one thing with actuaries. I mentioned actuaries. One thing I love with working with actuaries is they are really picky about the quality of the data and the quality of the stats. I remember working with one lady, Mary. We had this wonderful model, it was really quite powerful, but I could never get anything out from her department because she's like, I can get it better. I can get more precise, more accurate. It's like, I think it's good enough. She's like, no, give me another 3 months. I'm working. It's like, oh, come on. But I understood, you know, she made me nervous because I knew she understood her data far better than I did. And I knew she was really good at what she was doing. What I didn't know is how precise she was being. Was she being overly precise or not? And that, since I didn't have that knowledge, I really couldn't question her too much. But yeah, actuaries like to have very, very accurate data that they can rely on. Let's look at a few case studies. So British Petroleum destroyed the Texas coastline in 2010 with a major oil spill. And so I remember I found this article, and British Petroleum, do y'all remember that? That's kind of, y'all were alive then, right?
Yeah.
So you're what, in middle school or first grade or something? I don't know what, 2010, high school. Okay, so you might have remembered it. Well, you probably remember in high school, you probably saw the fish with oil all over them, the ducks and geese. I don't know what South Padre has, but anyway, oil everywhere. So British Petroleum said, hey, we learned from our mistakes. And here's some quotes from the article. The spill was perfect storm of aging infrastructure. So the aging infrastructure. They talked about overzealous cost cutting. So if you have a firm that's really into cost cutting, their earnings are not there, you have a new CEO, CFO come in, it's all about cost cutting. That can create big risk. And cost cutting with blindness. Too much focus on form over substance. They were just kind of just going through the motions. So they had procedures in place, but they really weren't watching them. They had warning signs, so those, you know, close calls, those earning warnings, they had those kind of things, but they ignored them. Really focused on profits. And they said there was no really overarching thing. It's just these kind of things all just came together. But now they're much better at risk management. All right. So what do you think? Do you think British Petroleum is better now after doing this? Well, unfortunately, I just lied to you. This was not an article I found after April 2010. This is an article on British Petroleum that I found that was written before that. It was written in 2006 because of another blow up they had. And I didn't even know I kept this article. I was looking through my old files and I found this British Petroleum. I'm thinking it's about the oil spill. And I look at it, it's like, no, it's 2006. And it's like, oh, that's pretty interesting. So the obvious question, did they learn from their errors? Obviously not, because all of that happened. Do you want a firm like Exxon or British Petroleum to be really good at preventing oil spills? Would that be important to you in your life for them to do that? And, you know, here not. Don't look at your notes. But in 2008, this is a quote from a CEO. Don't look at it. It's in your notes, but don't look at it. So this is a pretty amazing quote. It is hard for us, without being flippant, to even see a scenario within any kind of realm of reason. My word, he's putting like, this can never happen. This is 1 in a trillion event that would see us losing $1, not $10 or $10 million. This is a big firm in any of those transactions. All right. Low risk, right? This is almost risk-free. We're sitting on a great balance sheet, a strong investment portfolio, and a global trading platform where we can take advantage of the market in any variety of places. September 2008. Anybody want to guess who said this, unless you've already looked at the notes?
No,
Which company? Lehman is kind of close. I kind of mentioned it already. AIG. So this is the guy whose department blew up and brought AIG, which is a very impressive firm. No question, very impressive firm. John Toohey's from AIG. Ask him about it. As soon as you ask him about it, he always says, no, but I didn't cause that. When we interviewed him, he took my place at USA when I retired. And that's the first thing he said in an interview. I'm from AIG and no, I had nothing to do with it. Because it was pretty horrible. He was actually telling some of his stories that they couldn't even, don't wear a shirt with AIG on it. Don't have your workout bag with AIG on it, because that was during Occupy Wall Street. And people were beating you up for being on Wall Street. So people were actually changing in the old dirty clothes to leave work, so they would look like they were, not one of the professionals. It was pretty bad.
There's doing that in New York now. I mean, not for the same reason, but people in New York, they work at Chase. They're change out their suits before they leave, so they don't get robbed.
Get robbed. Okay, well, that's a little different. Here they're getting beat up and getting followed home and all that kind of stuff. So, it's, how can someone be that clueless, right? This is right before this whole thing's going to blow up. Now, was he clueless or was he just lying to the press? Which is it? He could have been like Nick Leeson is, yeah, it's a mess, but I might get that one lucky trade that gets me out of this whole mess. So if I just keep saying that everything's fine, maybe that's what his thought process. If you look this guy up, this is no lightweight. This is a very impressive person, very impressive resume, very smart, very quantitative. So he was capable of understanding this. So this is not someone who was being snowed by his department. He understood these traits. So, look at his resume. It's a very, very impressive resume. So I don't know, is he lying or is he just that clueless? Who knows? But that's what we have running our major financial institutions. A big part of this is forecasting. And it's not forecasting the future, it's forecasting this. This is really, I think, really critical in any forecasting. Get away from forecasting a future. Think of forecasting as a distribution. You're trying to forecast the distribution of the future. Forecasting should be a risk management tool. So you want to know what's the range of the future. And Doug Hubbard's going to talk about this. You want the range to be honest. As honest as you can make it. So if you're uncertain, that distribution better be really, really wide and really flat with massive tails. You want to be as honest as you possibly can. And so this article, I really like this article. It's out there on Blackboard. He talks about the cone of uncertainty. So I'm going to do a little bit of that. His 6 rules of effective forecasting. I do highly recommend you read many, many books on forecasting. My recommended book reading list has one really good book on forecasting. But change your perspective. Doug Hubbard is a lot about this. So change your perspective of forecasting. The goal of forecasting is not to predict the future. The goal of forecasting is to express your uncertainty. You want to put on paper your uncertainty. And so you forecast so that you can show how little you know, how bad could it get. If the uncertainty is too great, then Doug Hubbard says, well, go spend money on information so you can bring the tells in. Or go spend money on hedging so you can cut the tails off, one or the other. But that's really critical to risk management. And then y'all heard of this guy, right, Kahneman? He actually talks about what you can do to avoid biases in that forecasting, because biases are a huge part of our problems in finance. Let's look through, I'm not going to do this whole article, but I do think there's some things. Just to give you an example, I use this a lot of forecasting of the Olympics. The British government's budget for the games has risen 9.3 billion pounds. The initial forecast was 2.4 billion. If you were grading this student on their forecast, what would you give them? C minus, is that too good? You go to your boss, 2.4 billion, ends up being 9.3 billion. I remember I started in the life insurance company. One of my first meetings, the CEO, he was so mad that this IT project was up to $16 million. They told him it's gonna be $10 million. He's like, I mean, this thing just keeps getting higher and higher. So no, 16 million, that's all we need. I mean, I guarantee you a couple of years later, they were well over $100 million on that project. And he's mad because they went from 10 to 16. It's like we're really bad forecasters. Why? Who did this forecast? Someone who really wanted the UK to do the Olympics, or someone who didn't care? Someone who really wanted to do the Olympics, right? They had an incentive to lowball this. But that's just the UK, so that's not anybody else. Organizers of big sporting events tend to overstate the benefits and understate the cost. Why do they overstate the benefits? Well, on the Olympics, they say we're gonna have all these tourists coming in, look at all this stuff they're gonna buy. Well, that's true, but what do the locals do? the Olympics. We got to avoid downtown, right? They avoid shopping, but they don't subtract out the locals. They just add in the new. I've been to the Olympics once, and not as a spectator. I mean, as a spectator, not as a participant. It was amazing to me how little there was there. I remember the U.S. won first, second, third in the 400 meters. It was pretty impressive, really exciting. And I and the other 3 people in the stands were really excited about it. But there was nobody there. There was we were in Athens, and when the last Greek athlete finished, the place just emptied. No one cared anymore. And we're sitting there. We could see some Americans on the other side, and we kind of waved at them, and we're all excited. That's pretty exciting, right? You come gold, silver, bronze, and they won by a long distance. It was really, really impressive. I don't know what they did in the mile relay. They must have won that by, by half a mile. It was pretty amazing. There's nobody there. So, who's coming up with these estimates? Because it's the people who want this thing to be approved. So they have an incentive to exaggerate the benefits, underestimate the costs. They are particularly bad on opportunity costs, counting every penny spent, forgetting that others are going to avoid. So here, how bad is it? Not most, talking 100%. If you go to a company and 100% of the time they're really bad in one direction, does it give you an idea of what you might want to fix? We're always biased. We're always wrong by a big amount and always in the same direction 100% of the time. That sounds like an easy problem to fix, doesn't it? How bad is it? Every Olympiad has gone over budget, and the average is 179%. Well, obviously Putin got it right. So Putin quadrupled the original estimate, went to $10 billion, from 10 billion to whatever that, I can't do rubles. I don't, today it'd be, you'd have to multiply it by 2 probably. From 300 billion to 1.4 trillion. Now, obviously here, some people say Putin was doing the Olympics, not because he wanted the Olympics, but because he wanted to help his oligarchs out with some nice little business on the side. So there may have been some fraud going on there. Not that I would say anything bad about Putin. But at the most expensive, even in the London, with Russia, it placed a bid in 2008, proposed 12 billion, 50 billion, 180 again. Sochi, the overrun was 500%. And Russia, corruption is not a single side effect, it is the purpose. So I didn't say that. The quality work is patchy. Well, I noticed that in Athens or in Greece. Boy, they weren't ready, and so they had to just start pouring money into Athens. And so when you drive through Greece, there were all these projects that had been started that got just stopped. There's all these half-built buildings everywhere because everything stopped and everything's Olympics. They finished it pretty well. It was actually pretty impressive at the end, even though there weren't many people there. But it was a lot of money, and a lot of the stuff I don't think they had any use for afterwards. Some of the stands they built, there's like, what are we going to do in this now? So there's a lot of waste. So anyway, so here's the 6 rules. This guy, I don't know if this still works. It's from the Harvard Business Review. But this is why I changed. And I really recommend if you start with a company where you start on the forecasting side, I really think you should be asking these kind of questions. Why do we forecast? I'm in the camp that says you forecast for risk management reasons. The whole purpose of a forecast is risk management. Most people say we do forecasting to make decisions, but I've never seen a firm make a decision based on the forecast. They make a decision, they then build a forecast that matches that decision that's already been made. If you want forecasting help you with decision, you have to put that uncertainty in there. And if something's really uncertain, you might say, well, maybe we shouldn't do this. The downside is just too great. So the erroneous perception that forecasters make predictions. The primary goal of forecasting is to identify the full range of possibilities. So he's very much in my camp. Not a limited set of illusory uncertainties. Above all, the forecaster's task is to map uncertainty. For in a world where actions in the present influence the future, uncertainty is an opportunity. And we're supposed to map our uncertainty knowing that we're biased on the positive side. we're biased on the optimistic side. Knowing that we have that bias, we need to make sure the downside is great. Like I talk about with my graduate students, they do these projects, they come in, present it, and I ask them, what's your worst case? Our worst case is we make a lot of money. And I was like, I don't believe that. I don't believe you're going to open a franchise and your worst case is you make a lot of money. Your worst case is you lose every dollar you put into it because it didn't work out. It was a terrible idea. I mean, that is the worst case. Forecast has to be logic to it. The wise consumer to forecast is not trusting a bystander, but a participant, not a trusted bystander. And you need to have skin in the game. That's why I prefer interest rate forecasts from the bond market than from economists. Economists are wrong all the time and no one cares. But a bond market is wrong, they lose money. So I want some skin in the game. So what's a good forecast versus a bad forecast? So he says, he starts off with this cone of uncertainty. Just think of it as a distribution. Your forecast should be a distribution. That's why I like stochastic models more than just regular forecasts. Let's run 1,000 simulations of our future and let's see what the range is and let's see what's causing that range. At USAA, it was pretty obvious. It was hurricanes and earthquakes. It's an insurance company, property and casualty insurance company. But boy, we found something incredibly interesting. We ran those scenarios. One of the most interesting ones I found is when the bank was blowing up, the life insurance company was doing great. And when the life insurance company was blowing up, the bank was doing great. And both of these entities want to buy all this insurance to protect themselves. I was like, you don't need to, you're hedging each other. We've got this natural hedge between these two entities. One's very focused on short-term interest rates. One's very focused on long-term interest rates. One benefits when rates rise. One benefits when rates fall. I mean, it's like this perfect cohesiveness. But then the other thing was our CEO is really worried about rates rising. So he kept exposing us to rates falling. So then I brought the pension plan in and I said, well, if interest rates fall, we're going to lose a fortune on this pension plan. And that's when we immunized the pension plan. And I was able to show him that you're actually making us more risky. Our biggest risk is actually rates falling because of this pension plan and all of its duration. So this type of analysis, bringing it all together, I could show these extreme scenarios that what you're doing is actually making us more risky. We actually do better when rates rise than when they fall. And you have to be able to show them somehow to do that. Just a 1 point forecast doesn't show that because it just assumes rates are nice and normal. So effective forecast provides a context to inform your intuition. It broadens your understanding, revealing overlooked possibilities, unexamined assumptions. It narrows the decision space within you must exercise your intuition. A forecast's job is to define the cone in a manner that helps the decision maker exercise strategic judgment. So you're trying to get information on what drives this company. So, okay, we knew going in with USAA, we knew earthquakes and hurricanes were going to be the big part of the tell. But we could also test which reinsurance program best brought that tail down. Where could we best spend our money? The other thing I thought with USAA was really interesting that 5% of our members, our customers, were like 90% of our risk, our tail risk. And I was always like, why don't we just give them really bad service and they'll leave us and go to State Farm, and we can literally, if we got rid of those 5% of customers, USAA could have sent a $3,000 check to every one of the remaining customers. How many of those 95% remainers would have liked to have gotten a $3,000 check in the mail? It would have been pretty nice, right? All you had to do is get rid of 5% of your customers because they're 90% of your risk. But they said, no, our mission is to serve military people wherever they live. And yeah, there's a few of them that live on the coast. So, but at least you know now, you have that information, you look at it and see, what can we do about this? The cone can be narrowed and subsequent refinements, but your goal is to be as honest as possible. You want it to truly express how much you do not know. We don't like to admit ignorance, but he's saying you want to expose the ignorance, be as honest as you possibly can. The most commonly considered outliers are wild cards. These are trends or events that have low probabilities. If the events were to occur, would have disproportionate large impact. That's the black swan we're going to talk about with Nissim Taleb. What does Nissim Taleb say? Yeah, they're pretty rare, but they're actually the single most important things. The world has been defined by these black swans. It's not the normal stuff that's in 99% of the distribution. It's the 0.5% that defines the world. It's what changes the world. And that's what you need to be focused in because that's the most important stuff. And we have a tough time. I mean, honestly, who was sitting at Delta Airlines saying, hey, what if our revenue drops 80% next year? You think anyone was sitting there in 2019 asking that question? Probably not. Or Exxon, what happens if oil prices fall back to 20 bucks? Probably no one's asking those questions. And then that's exactly what happened. So, so go further extreme. Talk about Y2K, 9/11. Ask hard questions about whether a seeming wild card in fact deserves to be moved closer to the center. It's tough. We have a tough time thinking these things that don't happen very often because they don't happen very often. The second thing you talked about the S curve. I'm not going to get too much in that, but the S curve is some major innovation that radically changes everything. It's the Netflix impact on Blockbuster kind of thing, right? You kind of see it coming. Maybe it's electronic vehicles and its impact on Valero. Maybe it's autonomous vehicles and its impact on UTSA. We keep saying autonomous vehicles are right around the corner, and we keep turning the corner and they're not there. But the S curve, the way it works is that's what it does. You keep turning the corners and then suddenly it's there. And it's such a shock. And people are like, well, how did we not see that coming? That's the typical S curve. Historically, they always take longer than they should take, but when they happen, they completely wipe people out, even though people were talking about it 10 years earlier. So that's the S curve. I like one of the quotes he has in here. Don't confuse, I forget where he has it. Yeah, never mistake a clear view for a short distance. So just because we are confident these things are going to happen, you know, Google was saying autonomous vehicles by 2020. How many of y'all came here in an autonomous vehicle? I mean, your Tesla is not, and all of y'all have Teslas, your Tesla is not an autonomous vehicle. It can kind of be one, right? It's illegal, but it's not here yet. So they were off by how much? 2030, 2040, who knows? I'm hoping when I'm 85 and I can't hear or see or anything, I'm hoping I can just walk out and get in a car that drives me where I need to go. That'd be pretty nice. The next thing he says is embrace the things that don't fit because they're actually are the most important things. It's those things out of left field. It gets back to that S curve. That's why I really love Christensen's books on disruptive innovation. You should read his books. They're really, really good. I forget his first name, but Christensen, he unfortunately passed away a few years ago. I really like his book, Seeing What's Next. Really, really good book. But he's talking about these disruptions to industries, to companies that just seem to come out of nowhere, and yet people were talking about it 20 years earlier. And it's this idea of asking a question: could Blockbuster have done that? You know, you think about Netflix. When Netflix started coming along, there was not enough bandwidth to do what Netflix wanted to do. Y'all probably don't remember this, but you know, some of the stuff Netflix is doing today, it would have taken you 3 hours to load that back when they were starting. You know, they were looking way, way, way ahead, and Blockbuster was like, that's not going to happen. There's no way. And it happened, but it took longer. But Netflix decided to go ahead and invest in it and go for it, and Blockbuster just missed it. I love this as well. This is weekly with an A. It's not weekly with an E. So he says, have strong opinions, be confident, state that, go crazy, but then change your opinion really fast with new information. So the main thing I have here is express your opinion strongly, but then don't waste time and energy protecting your ego. Kill your ego. If you say something strongly to your boss, and then the next week you just go, that's wrong, you say, you know what, that was ridiculous what I said. Like, admit it. What we normally do is we say something strongly, and then we start doing what we call confirmation bias. We start looking for stuff to confirm what we just said. You actually want to do the exact opposite. I've done this with my reading. Y'all be shocked if you saw my reading list on Audible, but I'll sit down and say, okay, what do I absolutely convinced of? And what book expresses the exact opposite of that? I'm going to go read that book. So it's that idea. There's a great book I read. It's called Being Certain. I won't say it's a great book. It's not on my reading list, but it was an interesting book. I'll say that. But he asked the question, why do humans have this 100% certainty on some stuff that there's no logical reason for us to be 100% certain? And he gives a lot of examples of that. Probably the most interesting one is the the Challenger disaster. Yeah, I'm sure y'all don't remember that, but the Challenger disaster, when it happened, this professor, the sociology professor said, well, this is interesting. I'm going to do an experiment. So he had all of his students the day after that write exactly what happened the day before. Tell me where you were, what you were thinking. And so he collected those. And I think it was 2 years later, not 20 years later, 2 years later, he brought them back together and had them write it again. And y'all heard people like your grandparents say, I know exactly where I was when Kennedy was assassinated. Y'all heard that? They probably don't. Because what they discovered here is a lot of these people were wrong about where they were. Not only that, they were absolutely convinced they were more correct 2 years later than they were the day after. He talked to people who wrote a different story, and they said, no, I'm sure that's where it was. He said, but you wrote that the day after. He says, well, I must have gotten it wrong back then. They were 100% sure where they were, and it's pretty obvious they weren't. I mean, why would they have lied about that? Our brains are absolutely convinced of stuff. Why? It's probably just the nature of survival and all these kind of things. But we should start questioning ourselves more often. He wasn't trying to ask how to change that. He was more asking, why are we like that? It was pretty interesting. Why are we wired like that? So be willing to, one thing you can definitely do is try not to invest your ego to start with. So give yourself an out. We're going to talk about that when we talk about Annie Duke and her idea on decision making. Don't invest your ego. So if your boss come in, and Taleb's like this as well, your boss comes in, wants your opinion, give your opinion, but then also give some caveats. So this is what I really think. However, if the Fed does this, that's definitely going to ruin my idea. Give that caveat. So even if that doesn't happen, you at least have set up the idea that, wow, I could really change my opinion if something else happens. Our egos are probably the worst part of our risk management abilities because we prefer to protect our ego than our companies. So in navigation, lots of interlocking. Weak information is vastly more trustworthy than a point or two of strong information. Once researchers have gone through a long process of developing a beautiful hypothesis, they don't want to give it up. They've invested in it. Good forecasting is a process of strong opinions weakly held. If you must forecast, then forecast often and then change your opinion quickly. Having strong opinions gives you the capacity to reach conclusions quickly, and then changing them quickly allows you to discard them when new information comes forward. Here, I'm not as convinced on this one, but he did say, your banks did what? Go back 100 days? He's saying go back 50 years, go back 100 years. Technology is making that a little more questionable today, but go back further than you think you really need to if you can find the data. When not to forecast. So he's saying there are times you shouldn't forecast. I think Doug Hubbard would disagree with that. Doug Hubbard says, put everything down that you know. And based on that, put a forecast out. It may be so ridiculous, somewhere between 1 and 37 billion. All right, that's a pretty wide forecast. Okay, but that's where I am right now. I have no clue. And don't take a forecast too seriously. So there's some good ideas. The Kahneman, I won't go through Kahneman, but what Kahneman says is very similar to Annie Duke because she's using a lot of Kahneman stuff, is this concept of biases. We have these strong biases. And what Kahneman says is we have strong biases, and even when we know them, we still can't overcome them. We are slaves to our biases. We're always going to cave into them. So what Kahneman's asking is can we find some ways that we get better? And what he says is individuals know you're stuck with your biases, but as an organization, there are things we can do cooperatively that can help those biases. And so he came up with a list of questions. I don't know if he actually wrote this. Maybe he just stuck his name on it and somebody else does. But he says there's questions that the decision maker can ask themselves, and he gives a list of those questions. There's questions that the decision maker can ask the team members to try to figure out their biases. A pretty good bias is, we did this last year and it worked really well. Well, that's a pretty big mistake. We think, okay, we'll do this again. Well, it may have been lucky last time. What could go wrong? So they have this bias that they're getting excited. Hey, man, last time treasuries hit that rate, we did this trade and it made us a lot of money. They hit this rate again. Let's do it again. It's like, well, no, let's stop and think about this. And then there's questions you all ask together. I forget what this, where that last one is, on evaluating the proposal. And it's a really good checklist. Actually, I think this is actually a pretty powerful tool. The nice thing about a checklist is that it gives some structure to it so that it's a checklist on biases. So you're thinking biases, and now you got this checklist. I think it's going to help you make better decisions. I think Annie Duke has some good ideas on that as well. So these articles are out there if you want to read them. I won't go through the end of it. You can read the highlighted or read the entire article if you like. It's a little bit long. All right, so I don't know what I changed, but I want to talk a little bit more operation on Tuesday. If you'll get on the iClicker, just put it on your phone. What I'm going to do is I'm going to talk about a particular operational risk based on my career. It's one that's very sensitive, which I think will make it more interesting. It's a risk that I think the world has changed, that if this had happened today instead of during my time, I think the outcome would have been very different. But I'm very curious to see if you think that. Has the world really changed that much? And you'll see when we get into it. If you don't have iClicker, then I'll have you write on a piece of paper, and then the next class, I'll bring it all together and see what I think, because I'm really curious. I really have no clue what y'all are going to say.